The AI cycle is absolutely happening, and this trend is still very much ongoing.
You need to see some major shift in earnings dynamics or earnings leadership to see tech take a big step back here.
The bigger story has been some of the broadening out that we've seen in the market in recent weeks.
We're actually starting to see more stocks in the S&P 500 post positive year-over-year earnings growth now.
The need to rely on a single stock to power the market, I think, is diminishing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to a long weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, looking to close out the last week of August on a 4-month winning streak on the S&P 500. Equity futures look like this. Your scores shaping up as follows. Up 0.4 on the S&P, up 7 on the Nasdaq. On the Russell, the small caps up by 0.5. Your day ahead shapes up as follows. Kicks off at about 8:30 Eastern Time. Lots of data for you. Personal income and spending, core PCE. And then Lisa later on, 10 a.m. Eastern Time. You, Mitch, consumer sentiment.
This week actually was fascinating from one perspective, which is that, I know you're laughing. I mean, a lot of perspectives it wasn't, but this one it was. Essentially, you saw the Magnificent Seven holding back this S&P from reaching new all-time highs. To me, that is what's most interesting. People leaning into the soft landing story that much more, even with some hiccups, at least marginally, from some of the biggest contributors to the gain so far this year. This, to me, screams of just soft landing nirvana. We've been talking about that, and this full faith in the Fed Chair Jay Powell being able to cut rates without that weakness that most of the time happens in tandem.
For many parts of this equity market, good news is good news. Better growth data, firmer GDP, jobless claims contained, equal weight, another all-time high. The Russell of small caps outperforming. Can that continue? Let's talk about the consumer. The quote of the last 24 hours, the Dollar General CEO on low-income shoppers. Take a listen to this for a quote. Inflation has continued to negatively impact these households, with more than 60% claiming they have had to sacrifice on purchasing basic necessities. So the labour market says things are OK. Some of the commentary coming from some of these consumer-facing companies still pretty dire.
I'm really happy that you went there. To me, that was my takeaway from yesterday. The fly in the ointment was Dollar General shares down something like 30%, a record decline, after they reduced their outlook, saying that lower-income American households are running out of money at the end of every month. This is the area that gets hit hardest, and they are feeling the pain. Are we missing it? And I think that that's sort of the anxiety that people have, and the reason why there was such a relief rally on jobless claims yesterday that came in line. There is a feeling maybe we're missing something. We have had this many rate hikes, that we are seeing signs of discretion on the margins. Is this truly a painless disinflation?
The word of the quarter, I think, for these earnings, contradictory. If you listen to the likes of Dollar General, things aren't great. Best Buy, things are OK. Home Depot, not great. Walmart, things are all right. And that's been the problem, I think, over the last month or so, hearing from these companies. There's some fuel for the bulls, there's some fuel for the bears, but there's not much clarity on what's happening here.
There's a question about idiosyncratic, and that's what I was thinking as I was reading about Dollar General. They talk about increase in shrink, which basically is another word for theft. They talk about how their customers are the first to be negatively affected by deteriorating economic conditions. And then you see other stores that are similarly positioned that are doing just fine. It's a question of, is it strategy and a consolidation in the strongest players, or is this true signs of weakness? And it is very difficult to get a handle on that.
I loved how you just tried to describe this week as fascinating. Good attempt, Bramo. Nice try.
I'm trying. You know,
those quiet summer weeks we've all been waiting for, right?
Okay, there were some fascinating moments. I think that the fact that you're seeing the S&P 1% away from all-time highs, even though the Magnificent Seven is almost 12% away from their record highs, to me, that's interesting. I think it's interesting that we've seen, you know, such a long streak of wins for bonds. I think that it's interesting that there has been this embrace of soft landing, even with the Dollar Generals of the world raising some issues for it. So, yeah, there were some fascinating moments.
In a word, fascinating. From New York City this morning. Good morning. Welcome to the programme. If you're just tuning in, you haven't missed much over the last few days. Equity futures on the S&P 500 up by 0.4%, heading towards 4 months of gains on the S&P 500 and 4 months of declines on 2-year yields. And Lisa, I think equities and bonds speaking to each other on that front.
Yeah, longest streak of bond gains going back to 2021, and this comes with disinflation without a sign of deteriorating more generally in the economy. I think it's interesting. In Europe, we're seeing inflation come in below expectations, dropping to the lowest levels since the beginning of the pandemic. At what point is this the global immaculate disinflation, or are we seeing something else? Is it sort of in tandem that we can see risk assets rally in tandem with this idea of lower rates? I'm just struggling with that.
Dial 1-800 Frankfurt or Berlin.
Yeah.
And you'll get a very different answer.
Correct.
Nothing immaculate about it.
Yeah.
Pretty dire stuff.
Exactly. And so then why don't you just cut rates more significantly? And then there seems to be more reticence on the ECB with Isabel Schnabel. And just sort of this interesting dichotomy right now between the US and Europe.
The euro, 110.83. Coming up this hour, Jonathan Stubbs of Berenberg on why we might have another bubble in the making. Tobin Marcus of Wolfe Research following Kamala Harris's first campaign interview, and Claudia Sahm of New Century Advisors ahead of another read on inflation. We begin with our top story. Stocks edging higher. Going into this morning's economic data, Jonathan Stubbs of Berenberg has a warning for the bulls, writing US price sales multiples are back to 2000 peak levels. On this measure, it looks like we have another bubble in the making. Jonathan Stubbs of Berenberg joins us now for more. Jonathan, do we have another bubble in the makings? And if so, where is it and what are you advocating for?
Yeah, I mean, we've seen many bubbles in many asset classes over many hundreds of years, and in equity, 50 years, we've seen bubbles clearly. The point we were making in our recent note is that you take a reasonable measure like price to sales, and at a market level, the S&P is not quite back to its sort of peak 2000 levels. We're at a sort of 6 times price to sales against sort of 7 and change in 2000. But if you take the largest 10 stocks, we're back above sort of 10 times on a price to sales basis, having incidentally been 4 times at the recent sort of 2022 lows. So we've gone from 4 to 10 in the blink of an eye, and we're at and just above those 2000 levels. So valuation is giving investors a bit of a sort of sign of caution, just to sort of mind your eye and not just chase this blindly. That's our big point at this stage.
What do you think of the setup now compared to the setup going into August 2nd, the setup now going into September 6th? Going into the jobs report of August 2nd, we were in and around 5,500 on the S&P 500. We're actually above where we were going into that number, Jonathan. I just wonder from your perspective whether we are just as vulnerable this time around as we were a month ago.
Well, there's a couple of things. I mean, if you go back to the highs in July and run the market through to today, we've seen some big change in leadership that you were talking about at the top of the programme. We've seen leadership away from the US. So in dollar terms, Europe's +5, US is still sort of 5% off its highs. In sector terms, tech's given up, a short 10%. Financials and defensives are +10 from those July highs. So we've seen this rotation. I think the dollar's a big part of it. Dollar weakness has supported that rotation. And when you look at sort of some of the metrics we look at, some of the signals we look at, where we are now, given how aggressively and quickly markets have sort of bounced back from those sort of August lows, which seemed like they almost didn't happen. Some of the signals we look at show that we should again not be sort of chasing this market too hard at this point. One of the key ones we look at is a relationship between liquidity and equity. We put a note out in July saying that was stretched and suggested caution. Markets sold off from that point, but we're back to the same point now. So we're looking at markets, hopefully rationally, but the signals are telling us not to be aggressive at this point, and to exercise a bit of balance and caution.
There's a pretty big difference between exercising caution and a bubble warning that's going to mean some massive decline going forward. Where do you fall on that distinction in terms of just trying to be generally cautious and invest just with more of a sense of defensives versus wholesale go to cash?
Yeah, I mean, last time we sort of rang a bell was early January 2022. We wrote 2 reports called Crash Protection, and there we were talking about the pins that might burst what was a very inflated equity bubble in terms of valuation. That's very obvious when we look back. So it's a case of when you see valuations in this territory, and it's very US-centric, remember, because European, UK equities, rest of world equities look much more reasonable in terms of valuation. So there's more protection there. But from a US perspective, where are the potential pins? And the potential pins are around the debt burden, but it's hard to sort of know whether that pin is now, in a year's time, in 5 years' time. It's around geopolitical dynamics again. Trying to sort of pinpoint the exact date of when you might get risk activated is very, very challenging. So, the whole sort of challenge here for investors is not sort of running away just because of valuation data point, but exercising a bit more caution in portfolio construction. For example, US defensives, the block of defensives, are trading close to their record valuation lows going back 50 years against the rest of the market, and are trading at valuation levels relative to tech where historically they've performed strongly. So if you've done well by owning US tech, for example, maybe it's taking a bit of weight out of that and putting it into sort of cheaper parts of the market to provide more protection into a time when markets look pretty fully valued.
Can you elaborate on that, especially when you talk about don't chase this? Is this the general index going up? Is this the rotation into riskier assets? Is this the increase that we've seen in valuations for big tech?
Yeah, so I mean, there are various levels. We call this active hedging. It's one of our sort of cornerstones of how we think investors should approach all allocation, from asset allocation to equity construction right now. And if we take the overall US market, for the US equity market to deliver double-digit returns over the next 12 months, we kind of need sort of 15% earnings growth and a bull market multiple. That's above what consensus is expecting into a slowing US economy. So it doesn't mean we can't get that reasonable return from US shares over 12 months, but the hurdle's reasonably high, and therefore we go into the market and we say, well, okay, we quite like looking at growth at a reasonable price, or we quite like sort of buyback momentum strategies. We quite like looking at cheaper parts of the market which might be unfairly valued there, might benefit from lower rates or a weaker dollar. It's about, I think, sort of rebalancing portfolios at this point. It's not about sort of wholesale selling the market, but we do have some sort of caution signals as we've gone through already. But it's about sort of repositioning near term, also into an active risk period with the US election, with geopolitical risk very sort of alive in various parts of the world. So we don't think this is the point to sort of chase risk per se, chase tech per se. Broadening out, more balance, more protection at this point in time as we run into year-end.
Jonathan, you mentioned the elections. Can we finish on that? We'll have a deeper conversation in just a moment on this programme about an interview with the Vice President conducted just yesterday. To have the corporate tax rate come back up to close to 30%, 28%, to have a policy where we start to think about taxing unrealised gains in this country for very wealthy individuals, granted, how much of an impact could that have on this equity market?
Well, corporates the world over have benefited over 40 years from lower funding rates, lower tax rates, increased global trade, and all of these are sort of changing and sort of have changed in recent years. And corporate taxation is maybe the last sort of shoe to drop here. So these have all been sort of really significant tailwinds for corporate margins. And whether it's in the UK or the US, where there's obviously a sort of a two-way pull between the sort of different candidates, it seems that US corporate taxes are heading higher. One of the interesting points here is some of the companies with the lowest effective corporate tax rates over the last few years have been tech companies and big tech companies. In particular. So, if we are seeing in the US that sort of return to sort of higher taxation rates, which has been a big sort of boost over the last sort of 6-7 years, it's got to put a sort of net negative or a net headwind into play for the US. If at the same time it's into a softer dollar, historically that's broader leadership around the world, which is moving away from what we've had over the last 5, 10, 15 years, which is essentially sort of US-only leadership. I think that's quite a likely path that we take, this broadening out from a regional perspective.
I think we've had another all-time high in Germany. The equity benchmark in Frankfurt on the DAX. Yeah, Jonathan, thank you. Jonathan Stubbs there of Berenberg on the path ahead, and some difficulties maybe stateside in the next few months.
Yeah, especially with the potential tax changes that could come. Of course, our next guest is going to tell us why none of the policies actually matter. We're all focused on policy, but he says, actually, it doesn't really matter because nothing's actually going to get done given the makeup of Congress. So this maybe is one of the reasons why people are OK with a vibe-type campaign.
That's the assumption. Given the makeup of Congress, if we actually get divided government. I've had a few guests on this programme, including one from UBS, who said the market negative things that the former President Donald Trump would like, he doesn't need Congress for. Tariffs. The market negative things that the current Vice President would like, does need Congress for. And if you get a divided Congress, yeah, sure, we can ignore it. But who's to say we're going to get that based on the momentum we've seen over the last few weeks?
It's exactly the point that I'm hoping to talk about with Tobin, Marcus, because essentially at a certain point, if you expect that this momentum is partly to help the down-ballot races, well, at what point do you put a higher premium on a unified Congress with the party of the president?
That conversation just around the corner. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. ECB board member Isabel Schnabel saying the central bank should avoid cutting interest rates too quickly. Schnabel pointing to lingering services inflation that could hold back progress towards the central bank's 2% target. Traders are pricing in 2 to 3 more ECB rate cuts this year. China considering allowing homeowners to refinance as much as $5.4 trillion in mortgages. The plan is designed to lower borrowing costs for millions of families and boost consumer spending. Sources say homeowners would be able to renegotiate their terms before January, when banks typically reprice mortgages. And finally, Nvidia, said to be discussing joining a funding round for OpenAI that could value the AI startup at over $100 billion. Sources saying Apple and Microsoft have also been involved in talks about participating. More on that story a little bit later in the next hour. Up next on this program, plenty of talk, few specifics.
Day one, it's going to be about, one, implementing my plan for what I call an opportunity economy. I've already laid out a number of proposals in that regard, which include what we're going to do to bring down the cost of everyday goods.
Your long economic nightmare will very soon be over.
That conversation just around the corner. Live from New York this morning. Good morning. Live from New York City, welcome to the program. Equity futures on the S&P 500 positive by 0.4%, looking to bounce back. Strange session yesterday. Data was decent, equity market rallied. We were ignoring what was happening with Nvidia, and then it just all faded, Lisa, going into the close.
Yeah, and again, though, as scintillating as this week was, who knows exactly who was around to actually be doing that. Maybe it was just that, the algos ran out of energy. This is the issue to me. How much can you sustain the ongoing rally and the broadening out with that lifting all boats at the same time that you are seeing some ongoing questions about just the strength of the economy? That's my question.
A different person to the person we spoke to 18 minutes ago. Bramo said this week was fascinating. Now you sound incredibly cynical about the price action of the last 12 hours.
I think when you take a step back, come
course,
on, just leave me alone. It's been a long week.
Let's get Lisa to the weekend. Under surveillance this morning, plenty of talk, few specifics.
Day one, it's going to be about, one, implementing my plan for what I call an opportunity economy. I've already laid out a number of proposals in that regard, which include what we're going to do to bring down the cost of everyday goods, what we're going to do to invest in America's small businesses, what we're going to do to invest in families.
I'm here today with a simple message for the American auto worker and for the American worker. Your long economic nightmare will very soon be over.
So here's the latest. Vice President Kamala Harris pledging to address economic woes and bolster the middle class, but offering few specifics in her first interview since becoming the Democratic nominee. Tobin Marcus of Wolfe Research writing, "We did not expect meaningful policy news out of this interview. And sure enough, we didn't see anything that should concretely shift investor expectations for the policy outlook if Harris wins." Tobin joins us now for more. Tobin, just walk us through things then. Take a big step back. What stood out for you?
I think basically she did what she needed to do in this interview. I think on the one hand, some of the elements of the performance were a reminder that she does have significant vulnerabilities as a candidate, despite the fact that things have been going fairly well for her so far. I think that the most challenging part of what we saw yesterday was her attempt to account for the shifts in her policy positions from the very liberal stances that she was taking in the Democratic primary in 2019 to the aggressive move to the center that she's made at the top of the ticket over the course of the past 5 weeks. I think it was not terribly surprising that we didn't see compelling accounts of where those shifts came from, because ultimately, I think this is motivated by political considerations. She tried to pitch left to where she thought the Democratic primary electorate was at the time. Now she's moving to the center to try and appeal to moderates. So, I think the most important thing from a political perspective and from a policy perspective is that leaving aside the explanation for what changed, which is just the politics, she did cue quite clearly to the new, more moderate positions she staked out. I think that's sort of the essence of the task from a political perspective, was to say, no matter what I said way back then, right now, I'm here in the center where moderates are on issues like immigration and energy. And I think from an investor perspective, like the totality of the signals that we're seeing from her, from the Democratic National Convention, do, I think, point towards an intention to kind of govern from the center of the Democratic Party, notwithstanding some of the more liberal positions she's taken in the past.
Tobin, can we sit on policy just a little bit longer? What are the blind spots that you've got regarding Harris policy? Do you have a complete picture now of tax policy? What are the blind spots left for you?
I mean, I think we have a reasonably complete picture of what she's proposing. You know, as always, we don't have a perfect sense of the prioritization. You know, there's only room for so much in some fiscal policy bill next year. You know, the exact decisions about how she's going to prioritize the child tax credit against some of her new proposals on housing, against some of these quote unquote care economy issues like paid family leave and childcare. That much is not totally clear. But realistically, you know, even in the possible scenario that Democrats have a very, very narrow unified control of Congress, and I don't think that's what's going to happen, but it is possible, they're going to have no more than 50 votes in the Senate. And so ultimately what will get done will depend on what John Tester, senator from Montana, wants to do more than it depends on what Harris wants to do. So I think we kind of know enough about, you know, the big elements of the Harris agenda. There are certainly some questions about how she'll handle regulatory issues, you know, exactly where she'll land on antitrust. But, you know, this is not someone who's going to come in with a big set of majorities and a big mandate. It's someone who is going to have to govern, you know, through a fairly challenging period next year, given that you know, sort of DC is starting $4 trillion in the hole with the expiration of these Trump tax cuts. And I think she's just going to have to do her best to manage the trade-offs of the agenda that she's presented based on the majority she does or doesn't have in Congress.
Tobin, you said that it was really her main job to show that she was going to govern from the center, that she was going to be inclusive. She talked about including a Republican in her cabinet to try to get more perspectives around the table. We saw this just a bit with President Biden, where it was his approach to woo some of the centrists. And then in practice, he was swayed by the more left-leaning parts of the party. What's to say that it won't be the same for Kamala Harris?
It's certainly possible. You know, I think if you're an investor worrying about the effects of a Harris presidency, I think it makes more sense to worry about, you know, maybe she will end up putting, you know, really aggressive regulatory picks in at places like the FTC, despite the fact that that's not really what she's been signaling. I think that makes much more sense to worry about than stuff like this unrealized capital gains proposal, which has never come close to coming close to happening. And, you know, she's never actually said anything about it. All she's done is sort of decline to go through line by line the $5 trillion worth of taxes that Biden has previously proposed and say what she does and doesn't agree with, which I think, you know, it's not surprising that she's not wanted to kind of open that can of worms. So, you know, that I think has gotten much more attention than it frankly deserves. So there is a possibility that she ends up, you know, left of where she is indicating on issues like antitrust. But, you know, I think the most encouraging thing probably that we've seen so far is that she does not seem to be experiencing pressure from the left. I think part of Biden's move to the left was a very intentional effort to kind of bring them into the tent. We had these Biden-Sanders unity kind of task forces in 2020 as an effort to try and heal the, you know, the wounds of these big, you know, bitter primary debates that we had between the Sanders wing and the establishment wing in both 2016 and 2020. And Harris has not, you know, been experiencing pressure from the left. She's not, you know, felt no one's sort of complaining that she isn't talking about Medicare for all. The kind of climate folks are not trying to rake her over the coals for being fairly quiet about that element of the agenda. You know, at the DNC last week, I think that was the thing that jumped out. Like the party is unified, and you know, particularly in the sense that she is not kind of bowing to pressure from the left-wing policy demanders within the party, who, for the most part, everyone is just like so excited to have a potentially winning horse to cheer for and some shot at beating Trump that they're keeping their disagreements quiet for now.
Tobin, such a good final point. Tobin Marcus there of Wolfe Research. She's not bowing to pressure from the left because right now there isn't much. There isn't much pressure at all. The progressives are not forcing her into unpopular policy choices at all. Nothing like the way we saw things transpire 4 or 5 years ago.
Tobin put it perfectly. Basically, they're so excited about having a candidate who might win that they don't want to destroy it. You just wonder how long that's going to continue if she does win the election.
You asked the right question. How much daylight will there be between how she campaigns and how she might govern? And of course, a lot of that's going to come down to what the rest of Congress will look like. But ultimately, that's the question, isn't it? Well,
it is the question in terms of her trying to explain her policy shifts. If she leans into the idea of, yes, I'm a chameleon, I'm trying to represent the views of the people. And I go around and I try to get a sense of where people are at, and I try to represent it because we are of the people and for the people. That could work. I don't know. We'll see.
We got an interview. It's a good step forward. And hopefully get more steps, more conversations in the weeks to come. We need them. Equity futures right now on the S&P 500 firmer by 1/3%. Up next, cheaper prices, but more travellers. A Labor Day travel preview with Helane Becker of TD Cowen from New York. This is Bloomberg. Your scores this Friday morning and good morning look like this. Up by 0.4% on the S&P, on the Nasdaq 100 up by 0.6, a bounce back there. The Russell was okay yesterday. Outperformance this morning up another 0.4. On the month for the S&P 500, looking for a fourth consecutive month of gains on the S&P 500. And if you switch things up and get to the bond market, we're looking at a fourth consecutive month of falling yields on a two-year yield. Lisa, 390 at the front end of the curve.
Even with a 3% GDP being penciled in for this quarter, the sense that even though growth is good, even though we are seeing ongoing stability in the labor market, this Federal Reserve is going to have every ammunition to cut rates. And the why is in what we get today at 8:30, with core PCE likely to come in at some of the lowest levels that we've seen since the start of the pandemic.
And you, Mitch, consumer sentiment as well.
Yeah, how do you feel?
A little bit later. Big time. Wasn't called again, so missed the survey again. Still waiting for that call from you, Mitch. We'd like to make that happen one day. You will know that. Let's turn to foreign exchange. Take a look at the euro. Euro dollar looks a little something like this morning. 110.83. Eurozone CPI heading in the right direction for the ECB. No negative surprises at the aggregate level. Some encouraging signs at the national level with Germany just yesterday at the regional level. Lisa, when you break it down, this ECB is set to cut interest rates next month again. Whether they cut again and again, I don't know. Isabel Schnabel, the ECB executive board member, was pretty vague about that. I think they still want to give you the impression that they're very serious about keeping inflation down to 2%. At the same time, the Federal Reserve is starting to focus on the other side of the mandate. The ECB is a single mandate central bank, so this is all they can do.
You know, last week, again, I keep going back to these discussions with Olli Rehn as well as Mr. Kazaks of the ECB Governing Council. Both of them were talking about how we'll see. They were vague also, but on the opposite direction, saying that their biggest concern was weakness in the economy, not a sort of reignition of inflation. So I don't know how much signal there is to take from Isabel Schnabel. She might be trying to sort of just cast doubt in there. That said, why should the ECB cut rates less than the Federal Reserve, given the fact that they have disinflation, a 2% reading for German inflation now, which is the lowest going back to 2021, and the weakness that they're trying to prevent?
I think we've had a really good conversation so far this week about unlocking dollar weakness and what we need to see. Normalising interest rates is a piece of that. Connected to it, rebalancing growth differentials. It's difficult to see that evolving when the numbers out of Germany are as bad as they are and the struggles out of China continue, which I guess is why we're still around 110 on euro dollar. The Chinese currency strength is interesting. Whether that can really extend from here, a big question mark around that, I think.
A lot of it really lives and dies on whether the PBOC wants to actually deploy fiscal stimulus. There was actually a surge of cash into Chinese equities from foreign investors over the past week. I find that fascinating. It's the belief that we've seen the trough with officials there really beginning to desire to step in, which is the reason why it was notable to see sort of the adjustment around possibly refinancing mortgages.
Some of those flows starting to reverse just a little bit. Under surveillance this morning, the latest Bloomberg Morning Consult poll showing Kamala Harris leading or tied with Donald Trump in each of the 7 swing states. It's particularly notable in North Carolina, where Harris has a 2-point advantage. No Democrat has won that state since Barack Obama back in 2008. Harris has the momentum.
And that's the reason why you see former President Trump really trying to be more aggressive on the other side. Did you see this whole thing about possibly backing a ban on backing sort of a repeal of this law in Florida that Trump was talking about for having abortions by 6 weeks, and he's coming out and then he incurred the wrath of other people talking about how the government should pay for IVF treatments for people, trying to figure out how to cater to a cohort of voters who are moving away from him. I wonder what else we see on that front as we do see that momentum squarely with Harris.
Double haters. Harris is doing a better job at converting the double haters, based on the commentary we've heard on this programme. And for the former president, and we had a guest in the last 24 hours or so who talked about the limits, the ceiling of the former president's audience to attract more people. Got to try and change the tune when it comes to moderates. And I guess that's the first attempt at doing so, and maybe we'll see more.
Maybe we'll see more, or will it just be get out the vote? I mean, again, at a certain point, if you have a ceiling to your supporters, but they are diehard supporters and they're going to come to the polls, well, lean into them, right? Which is sort of what J.D. Vance was supposedly trying to do. Just a real question here about political calculus at a time where you're trying to lure in a lot of people who have felt quite disenfranchised in general from the political machine.
We'll come back to the politics a little bit later. I want to get to our report here at Bloomberg on this story. Intel working with investment bankers to navigate the most difficult period in its 56-year history. The chip maker said to be discussing a range of scenarios, including a split of its product design and manufacturing businesses. Lisa, that stock up in a pre-market, 2.6%.
I thought the story was fascinating. So Pat Gelsinger has been trying to lean into a host of different efforts, including this foundry. But part of the problem with it is that it mostly just makes chips, or it will only make chips for Intel. It isn't necessarily going to be the foundry to the world the way that they want it to be, rivaling the likes of TSMC. To me, this is sort of the existential question. Can you turn it around at a time where there are quickly moving technological advancements and the big are getting bigger and more entrenched in the business? And to see how they sort of offset some of the weakness that they've already seen will be really interesting.
I'd make 2 points. One, we spoke all day about NVIDIA yesterday, and I don't think Intel came out of my mouth once. That's a problem for Intel. Two, when you listen to analysts around this story, the word specialization is really, really big right now. NVIDIA specializes in design, TSMC specializes in fabrication. What Intel stands for, what they specialize in, isn't that what we're trying to address here?
Yeah, essentially, how do they get into the AI world with that high-tech specificity? Issue is, how do you get a lot of the talent to do it? There is a whole machine in place in Taiwan to sort of train people how to work at TSMC, how to produce the chips that really have fueled the whole AI revolution that Dan Ives was talking about yesterday. How does Intel do that in the U.S.? How does the Intel do that in other places where you don't have that same infrastructure?
See what changes we get. That stock is up in the pre-market by 2.6%. The latest reporting from our colleagues here at Bloomberg. Let's turn to this story. You might be travelling today. Record crowds and lower prices are set to be the theme for this Labor Day travel weekend. The AAA expected domestic travel to jump 9% from a year ago, while seeing a 2% drop in the overall cost of travel. Joining us now is Helane Becker of TD Cowen. Helane, walk us through the numbers. How busy is this long weekend going to be?
Yeah, good morning. I think we'll see about, in terms of air, 17 million-ish people will travel this weekend, which is about an 8 or 9% increase over where we were a year ago. So we're seeing nice strength. And a lot of that is in the domestic market where we're seeing lower fares, because we still have too much capacity in the airlines. While they are removing seats for the fall, late summer here, we still have quite a lot of seats available for sale. So good demand and good prices.
Walk us through consumer confidence at the moment. When we look at the data, Helane, what it tells us is that overall they still seem okay, but underneath the surface they seem less confident about finding work. When you start to move into that world, who's actually travelling in this country at the moment?
Yeah, Jonathan, so we're seeing two cohorts travel. We're starting to see a slight uptick in corporate travel and not so much business travelers who have never really gone away. It's just the managed corporate travel that we're starting to see come back. And that came back, it stalled, it came back a little bit. We're still below where we were 5 years ago, but we are seeing that cohort come back, especially after Labor Day, as we see more people return to office more days of the week, and as we see more conferences. September to the beginning of November tends to be a big conference season, as does March to May. So we do see that cohort travel. And then the second cohort that we're seeing travel is people who are still doing bucket list trips. We're definitely seeing them on the road. And we are also seeing people who are comfortable spending money on travel and on experiences and continuing to do so versus goods. So we have seen that. The cohort that we're not really seeing travel is the heavy leisure travel, people with very young families. Those folks generally do 1, maybe 2 vacations a year. As we go into the holidays, they'll want to travel. So not so much in the fall do they travel as much as the other 2 cohorts or 3 cohorts I mentioned.
Helane, can you just sort of square the circle for me, this idea that we're seeing a record volume likely of travelers this weekend, and yet there are still a lot of open seats and prices are down. Does this mean that a lot of airlines have just increased their capacity more generally? Does it mean that there's some disconnect here in terms of where everybody's going and it's very consolidated?
Yeah, Lisa, that's a great question. We're seeing this really interesting mix of travel because we did see too many domestic seats, but then airlines complain that they're not being able to get their capacity, their new aircraft from Boeing or Airbus. So you have the complaints and the laments that they don't have enough aircraft, but then on the other hand, they have too many seats on the planes. So yeah, we're definitely seeing, we saw a lot of capacity go into the US domestic market in the last 2 summers, but we saw the travel demand really be internationally focused, especially Europe. And this summer we saw very strong Asia travel. So those 2 markets were very strong for demand versus the domestic market, where people kind of did that in 21, 22, maybe early part of 23, and then 23 and 4 really shifted to do more international.
So why don't they just take the airplanes that are going domestic and make them international? I mean, why don't they just shift the composition of planes? Because that's what it sounds like the issue is, less than just overall capacity. Am I wrong here?
Well, no, yes and no, sort of. So every aircraft has every airplane.
You're too polite, Helane.
So the way to think about it is not every aircraft can do every mission, and not every domestic aircraft can fly internationally. You have to have overwater approval. You have to have the range capability. So yeah, they can't necessarily just mix and match that way. Some aircraft just don't have the range to do transatlantic or transpacific. So they would need to have a wide body aircraft like a 787 versus a let's say an A320 current engine, a CEO versus an NEO. So yeah, you're not going to be able to do that, but it's a great thought.
Helane, before you go, I'd love your thought on why Alaska and Hawaiian can get together, but JetBlue and Spirit can't. Why is that the case?
Yeah, Jonathan, that's a fair question. So here's the thing. For JetBlue and for Spirit, you were actually seeing a completely different merger. You were seeing JetBlue was going to absorb Spirit into its network. It was going to reconfigure the aircraft. The aircraft had more seats. The Spirit aircraft had more seats than the JetBlue aircraft had. So you were looking at, on some aircraft, 180 seats-ish going to 162-ish seats, or 220 going to 180, depending on the aircraft type. So you were taking seats out, and the concern, I think, among Justice and Transport were that they were going to raise fares and remove an ultra low cost competitor from the market that appeals to a certain cohort of traveler, and that's the one looking for deep discounted tickets. The look for Alaska and Hawaiian is completely different. You don't have a lot of overlapping routes. There are only 3 where you go from 2 competitors to 1. Alaska has said they were going to keep the Hawaiian brand, which is iconic, right? Helane is on the tail of the Hawaiian aircraft, and the Eskimo is on the tail of the Alaska aircraft. So they're not going to absorb Hawaiian into Alaska. They'll continue to operate 2 separate brands. Hawaiian's balance sheet's a little bit stretched. They just borrowed money at 11%, which is in this market very high. And so you have to think about what that's going to do to their not only the balance sheet, but also in terms of interest expense. You're going from, I think they replaced debt that was 2 or 3% with 11% debt. So you have a huge jump, which puts pressure on pre-tax margins. And nobody wants to lose the Hawaiian brand. It's, like I said, it's an iconic brand. And it offers a great product. It's a great management team. So that merger is just looked at differently than the JetBlue Spirit one was.
Helane, appreciate your time this morning. Thank you. Travel safely this weekend. Helane Becker there of TD Cowen. Great customer service on Alaska. You ever flown Alaska?
I have, actually.
Fantastic customer service.
I just loved actually being in the Alaska airport and watching all the cargo ships, because all the cargo planes come in to Alaska as a refueling spot, and they come to get all the fish, all the salmon, and then they fly it out frozen on these huge cargos.
Is that what you flew in for? Bit of plane spotting? That what you're into?
Yeah, definitely.
Vacations.
Yeah, it's fun.
Equity futures right now on the S&P up around 1/3%. Let's get you an update on stories elsewhere this morning. Nothing wrong with that if that's what you're into. Here's your blooming brief. UK home prices dipping unexpectedly in August. Data showing a 0.2% decline in prices versus estimates calling for a 0.2% increase. The average cost of a home was just over 265,000 sterling, up 2.4% from a year earlier. That's 3% below the all-time high reached last summer. Chinese automakers are feeling the pinch in Europe as new tariffs take effect. Top electric vehicle brands, including SAIC and BYD, seeing a 0.3% drop in market share from a year ago. The tariffs launched in July, raising duties on Chinese-made EVs to as high as 48%. And finally, Lululemon trimming its sales and profit outlook for the year as inflation and increased competition curb demand. Comparable US store sales falling 3% in the second quarter, missing analyst expectations. Shares actually rising in the pre-market after the initial drop. We're up by 3.9%. Apparently baggy pants are the issue here. Bramo, did you see that?
Yes, I did see that. The fact that essentially people are done with the tight,
Okay.
and Lulu is all tight. And they want more kind of, the loose, the aloe, right? The aloe yoga, like Beyond Yoga, those types of things.
If you go on the Lulu website, though,
gory.
and you click on the range, the top line, it's all loose pants. So they make them. I just assume people don't want them.
I think that they're trying to revive their impressions. There also was issues with some of the fabrics. That's been a long-standing issue that comes and goes, issues with the fabrics.
What's the issue with the fabric?
That it wasn't as high quality and people were complaining, and so they were going to other places, and they're saying that they're going to turn that around, and that's the reason why stocks are rising.
Dana Telsey with us a little bit later to talk about the fabric and pant fit and all of that. Up next, 25 or 50.
Given the current conditions that we're looking at today, I think the Federal Reserve is going to err on the side of caution and go with 25 basis points at the next few meetings. That's going to be very important. The Fed essentially showing willingness to lean against that labor market risk.
It took me a while to go with pants and not trousers, you know.
Really?
Yeah, because in the UK we don't call them pants. Pants are underwear.
What? Why did you switch then?
Lived in America a long time.
Yeah, see,
people won't understand me. So you adapt and adjust.
Okay, hold on a second. You adapt and adjust.
You adapt and
like
adjust.
American companies. But there's this question of when you go back, do you say pants and does everyone look at you?
You integrate into society the best way you can. And that's what I do. I'm integrating, all right?
Good to know.
More on the Federal Reserve. Up next, from New York, this is Bloomberg. Taking abuse in a commercial break for the word blooming.
Oh, yeah.
Yeah.
Well,
It's pretty old school.
Oh,
it's pretty old school.
It's bloomin' awesome. You should use it more often.
Thank you. All right, it was an accident. Forgive me. Under surveillance this morning, 25 or 50.
Given the current conditions that we're looking at today, I think the Federal Reserve is going to err on the side of caution and go with 25 basis points at the next few meetings. The Fed has been, lucky enough to have that combination of resilient economic activity and bring inflation closer to the 2% target without inflicting too much pain to the labor market. That's going to be very important. The Fed essentially showing willingness to lean against that labor market risk.
Here's the latest, a little under 2 hours away from a fresh read on the US economy with core PCE and personal income and spending data due at 8:30 Eastern Time. Claudia Sahm of New Century Advisors writing, none of our output metrics point to a growth scare, and none argue against the Fed rate cut either. With the expansion of the labour supply and higher productivity growth, recent growth has not shown signs of an overheating economy. The soft landing remains the base case. A good friend of this programme, good friend of ours. Claudia joins us now for more. Claudia, welcome back to the programme. We started this morning and this hour with this quote, and I wanted to share it with you. It came from the Dollar General CEO on low-income shoppers. Inflation has continued to negatively impact these households, with more than 60% claiming they have had to sacrifice on purchasing basic necessities. It's difficult to really get a complete read of what's happening with the consumer right now, Claudia. If you're asked, and I'll ask you, how would you characterise the overall situation for consumption and the consumer in America?
Right, so I think this is what is always difficult with U.S. consumers. We have a population that has very different income and wealth and needs, and it absolutely makes sense that right now we are years into inflation that has been higher than normal, and it's going to hit people at the bottom hardest. So that's why it's so important, in particular, to keep the expansion going, to get the labor market, have the hiring rates, the jobs there. These are the consumers that absolutely depend on their paychecks to make things work. So overall, the picture is good, but that does not mean that it's good enough. And it doesn't mean that it stays that way, particularly for certain groups that are under stress like that.
I know that's why, one of the reasons why you were happy with the shift from Chairman Powell in the speech just last week. A question we've explored through this week is how much daylight there might be between him and other members of the committee. Do you see this whole committee moving in the same direction, or are you starting to see some division, some splits, some cracks?
It's important for there to be differences of opinion and a robust debate among the committee. We should be most worried when they're all singing the same song, right? Like, this is a really complicated question. Are we moving in the direction that Chair Powell laid out? Absolutely. And I think you can even see that in the minutes from the last meeting before we got the July employment data that was so disconcerting. So I think that's where we're headed. I expect we'll continue to get good news on inflation. That's important. That's why interest rates are high, is to help get inflation down. We're making a lot of progress there, which means that can really pay attention to the slowing in the labor market. And with maximum employment, what you want is the most employment possible without creating inflation. If we are making progress on the inflation check, they can ease up some on the interest rates, and they should ease up some on the interest rates so that the labor market can kind of get its footing back and bring some more of these workers back online.
Claudia, you say get its footing back. Where do we have a sense that the labor market is losing its footing?
I think at this point, when you see the job gains have slowed, probably most worrisome is the fact that the hiring rate. So for people who are coming into the labor force, whether that's coming out of schooling in their first job or we have a larger immigrant workforce at this point, like, it is harder for them to find jobs. And there's a real disconnect between, what the hiring rates look like, which are much lower than just, a couple years ago. And frankly, go back to kind of 2014, 2015, that wasn't a great labor market. So we need people coming in to bring their talents. And it's not just about the fact that, yes, layoff rates are at all-time lows. That is excellent. Let's get hiring rates up to all-time highs again. So I think we've got some disconnect in terms of who is really getting hit in terms of opportunities, and we just kind of even it out. We're still coming out of an adjustment, and there's no reason for further cooling in the labor market. We don't need it to get inflation down, and it's a real loss in terms of our what we can do as an economy if we have people on the sidelines.
Claudia, you created the rule that so many people have been citing over the past few months from the Fed and beyond, the Sahm rule, which talks about a 0.5 percentage point increase in the unemployment rate over a 6-month period of time. We have seen that. What would give you much more pause in this upcoming report that we get next Friday, that maybe this is really, truly a much more quickly deteriorating labor market than we otherwise had thought?
All right, it's true. One's got to take big picture view. A lot of the information we've gotten outside of the labor market looks pretty solid, right? So there's no one report that's going to be game changing in terms of how we think. Clearly, we're looking for the unemployment rate to maybe come back a little bit. Some of that was a temporary layoffs, that a blip in it. We want to see the payroll numbers stabilize. Things that look worse, or we don't unwind some of July, is going to give pause. But really, it's watching this. We're looking at trends. We're looking at contours. There's no magic number here with the Sahm rule to try to get a sense of it really is about the direction. And we should expect to see over the next several months probably still some more softening in the labor market. Just because Chair Powell or the Fed gets going doesn't mean everything changes on a dime, right? Like, we really do have to see policy change and then, understand better how things are evolving in the labor market. And the confidence of businesses to hire is an important piece of it as well.
Claudia, we're always lucky to catch up with you. Thanks for your time this morning. Claudia Sahm of New Century Advisors on the labour market, on the consumer. Pertinent given what's coming up next week. September 6th, the payrolls report. 24 estimates are in our survey at the moment. Could change, more will come. The median right now, 160,000. The previous number, Lisa, 114.
And what will these numbers mean to this market? Some people are saying it might actually matter more what the unemployment rate is than even the headline number, just simply because of exactly what Claudia was just talking about. Those adjustments, how do they fit in?
Big jobs report just around the corner. A preview coming up in the next hour. We'll catch up with Ed Yardeni of Yardeni Research, Matt MacGuineas of the Committee for a Responsible Federal Budget, which always makes me laugh because we don't really have one. Jonathan Miller of Miller Samuel and Jeremy Stretch of CIBC. All of that and more still to come.
There's been a deterioration in the labor market in the U.S.
Should we see further weakening, the Fed will be likely to step in.
That's going to be very important. The Fed essentially showing willingness to lean against that labor market risk.
Well, I think what the FOMC is going to have to do is just wait to see what happens.
Indicators are pointing to slowdown, but the market's less concerned about that, and the market's focusing on rate cuts right now. And the Fed has to deliver.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This is Bloomberg Surveillance, and the second hour begins right now, live from New York City this morning. Good morning for our audience worldwide, getting you to the weekend with a positive equity market, for now at least. Let's start with the scores. Equity futures on the S&P 500 up 0.5%. On the Nasdaq 100 up by 0.8 in yesterday's session. The small caps outperforming on the back of better than expected economic data. Jobless claims largely in line, GDP better than expected. On the Russell, we advanced by 0.5% on the session. So that's stocks, on the S&P at least, poised for a fourth monthly advance, closing out August with a gain of a couple of percentage points. In the bond market, let's switch up the board and get to a 2-year, 10-year and 30-year. The 2-year at about 390.21, the 10-year 385.76. On the month, as equities go towards a fourth month of gains, 2-year yields go towards, Lisa, a fourth consecutive month of declines. And we said a little bit earlier this morning, bonds and stocks speaking to each other, the prospect of lower rates.
And the prospect of lower rates ahead of a downturn rather than in response to a downturn. And this is essentially what Jay Powell heralded during the call that he had in Jackson Hole, a question around whether he was trying to say mission accomplished at a time when we still have not yet seen the full ramifications of just how far a potential weakening in the labor market could actually go.
He came really, really close to saying mission accomplished. He used the word my confidence. And we've heard from several Fed officials since we heard from Chairman Powell this time last week. There appears to be a little bit of daylight between the Fed chair and the rest of the committee. We've still got some more data to come. September 6th, we've got the payrolls report. We can talk more about that. September 11th, we've got CPI, which we've hardly discussed. Maybe there's something to be seen there. September 18th is the Federal Reserve meeting. So we've got a few more weeks of economic data to try and get that committee on the same page.
Yeah, although the data has been so confusing. And I wonder, actually, what you think about this. I was thinking about this last night. I'm actually less interested to hear from Fed officials right now. I'm more interested to hear from CEOs of what they're seeing on the ground, because that's just as contradictory as some of the data that we're getting elsewhere. And frankly, I'm having a hard time reconciling both this enthusiasm that the Fed can cut rates as aggressively as they can, while also betting on the recovery that that's going to engender before the downturn that ever happens, which is essentially the rotation that we're getting in the equity markets. I just wonder how consistent these two ideas are at a time where there is a lot of contradictory data, both from the headline numbers as well as by companies.
There are certain words, when said too often, starts to make me nervous. And that word is idiosyncratic. When I start to hear the word idiosyncratic too many times, typically we'd associate that with EM. If you say enough about too many different things, you've got a much, much bigger, broader problem. And when you start to think about consumer-facing companies over the last quarter, let's go with Home Depot, Lowe's. You can make the argument that that's idiosyncratic. That's the housing market. They're being held back. You can make the same argument when it comes to things like Lululemon, idiosyncratic, right? You can pick out consumer company after consumer company and make the argument that it is idiosyncratic. But if enough companies are revising down their outlook for growth, Lisa, don't we have a problem when it comes to things like hiring, when it comes to things like firing for the months and quarters ahead?
Yeah, I completely agree with you. I mean, we were talking earlier with Dollar General. I'm sure we'll get there in a second. We also saw Big Lots reportedly considering talking about a bankruptcy or filing for bankruptcy yesterday with the downturn that they're seeing in consumers. My issue is, at this point, when you take a look at some of the motley numbers from companies, are we looking at something that's overall, or is the confusion that we've seen from the post-pandemic cycles, the sort of economic cycles that have been specific to different companies, does that muddy the waters even more? I mean, it just is it's a hard thing to really reconcile.
The same is true of the economic data. The economic data at the aggregate has been misleading at best. The bifurcation has been extreme now for a number of years, through the pandemic and out the other side. And the Dollar General quote that we've been quoting over the last 24 hours speaks to that. Look, this is not LVMH, to state the obvious. We're talking about catering to low-income shoppers. And words like this are pretty concerning both for the government and the central bank alike. When you hear from the Dollar General CEO, and he says things like, inflation has continued to negatively impact these households, more than 60% of those households are claiming they have had to sacrifice on purchasing basic necessities. TK's really good about this. He'll talk about most of the country, half of the country being flat on its back. He's being loose with the numbers there, but that's what he's speaking to, a large proportion of society really struggling to get by day to day, week to week, month to month.
And the specificity in the Dollar General reports talking about how their consumers are running out of money at the end of every month. This question about credit, right, and the availability of credit to lower income consumers. This goes to the rate picture, but also this question of the overall expenses are going up. That's why housing has become such a big issue and maybe less idiosyncratic than it otherwise would be, considering the effect on the customers of the likes of Dollar General.
Big conversation about housing a little bit later. I want to go through the day ahead. Still got some work to do before we get into the long weekend stateside. The day ahead looks a little something like this. 8:30 Eastern time, we get some data for you. We'll get personal income and spending data. Mike McKee will drop by the studio and break that down for you. A read on core PCE at 8:30 Eastern as well. A little bit later, Mitch, consumer sentiment data too. I think consumer confidence is really interesting right now because earlier this week, we had consumer confidence which said things are OK. Then you've got all these individual subcomponents. And when they start to talk about the labour market, when the consumers start to say we're not as confident about finding a job, that's when the cracks start to appear. And I think this is really important going into payrolls next Friday. Payrolls next Friday, for those of you interested, I've gone through the numbers a few times. The median estimate in our survey is 160. That's up from 114. The expectation is that unemployment actually drops from 4.3 to 4.2. And what happens here really sets the stage for the debate about whether the Federal Reserve has to go 25 or 50 or would indeed go 25 or 50 next month.
And to be very clear, this is especially important because we have seen the University of Michigan Sentiment Survey sway the Federal Reserve in the past. Remember when inflation expectations went up significantly in this survey, that was what actually was the catalyst for the Federal Reserve. I'll add to that, the Fed Chair Jay Powell talked about victory not over inflation, but over inflation expectations, and started talking about how that has not become unmoored. He sees control there, no runaway inflation in the expectations. This is a direct point to the University of Michigan Sentiment Survey, which includes those inflation estimates that I know that you want to be called on.
I'd love to call.
I think that you should, which I'm sure that you would skew the statistics quite considerably.
I'd at least try.
Which is the reason why they're never going to call Jonathan Ferro. But to me, this really highlights sort of the intersection right now between what the Fed's trying to do and what they can do. They can affect market conditions. They can affect consumer expectations for inflation. How much can they actually change the economy on a dime right now? Not that much. And the market's already priced in a lot of these cuts.
You mentioned a few times contradictory signals. I remember something you said maybe 12 months ago, that when the data starts to contradict, it could mean we're at a turning point. I think that was building on a conversation you'd had with the San Francisco Fed President Mary Daly. That's what it feels like right now. And the division you see on Wall Street, let me just give you a snapshot of the division on Wall Street right now. The difference of opinion based on a spread of 60,000 on payrolls. The difference of opinion, 60,000, and yet the views are polarised. Citi and Andrew Hollenhorst are looking for 125 on payrolls next month, yet they're looking for a 50 basis point cut off the back of this. The multi-month rise in the unemployment rate is not a weather-related distortion or the consequence of surging labour supply. It reflects a slowdown in hiring, which will likely continue and eventually worsen into outright layoffs. Morgan Stanley's looking for 185 on next month's payrolls report. So the payrolls report we get on September 6th next week for the month of August. And they've got a completely different view on the weather. In the weakness of the July jobs report, some was weather, some was noise, and some was the slowing trend. We expect a partial reversal in August payrolls. Look for 185 and the unemployment rate to drop back to 4.2%. We're all looking at the same data. We have very similar views. I've got to say, 185 to me is similar to 125, given the revisions we've just seen over the last 12 months. Yet they have radically different opinions on what the Fed will deliver next month, 25 versus 50.
And part of what's underpinning that is the trajectory of where these numbers are going. We've heard from Andrew Hollenhorst over at Citigroup. He does believe that this is an economy that's declining quite considerably. Morgan Stanley very much in the soft landing camp. This comes at a time, though, and I really want to point this out. You're hearing from Dollar General, but you're also getting annualized GDP that yesterday was revised to up about 3% from the previous 2.8%. You're hearing from companies saying that their profit margins are expanding. This isn't typically a time where they will start cutting jobs in a more significant way. It is that contradictory data that Mary Daly was talking about that always happens at turning points, but it has been so contradictory for so long. And this is the reason why I think people are kind of feeling frustrated almost. Give us a signal of where it's headed, because it's very hard to get that right now.
If you are just joining us, welcome to the programme. Let me give you a snapshot of price action right now. Equity futures positive by 0.4%. We talked a little bit about the bond market going towards 4 months of declining yields. On a 10-year at least, we're at 385.57. At the front end of the curve, on the 2-year, we're at 390. I want to sit on foreign exchange just for a moment at 110.83. The dollar index having one of its worst months of the year so far. But over the last week, actually the first week of strength since mid-July, we've had a string of dollar weakness, weekly dollar weakness, about to get a weaker strength.
And this came after weaker than expected jobs data, right? So that some of what we saw that really triggered the expectations for 100 basis points of rate cuts this year by the Federal Reserve. It was just added to by a Fed Chair Jay Powell, where the reaction function will be to cut rates pretty much for any reason next month, and then to continue it with a rate cutting path. But then it's been reality checked by what's going on in the rest of the world, in particular over in Europe. And I've got to say, today's inflation reads were very interesting to me. The idea that German inflation came in at 2%, that was below almost all estimates, down from 2.6% in July, and the lowest since 2021. What is the argument? I keep going back to this. What is the argument for the ECB not to cut rates more significantly than the Federal Reserve heading into year-end, considering the weakness in that region as well?
Can we unlock more dollar weakness? This is a big theme. Stephen Jen, I think, with the quote of the week regarding the FX market, believing that a lot of money has come from China into the United States to grab income, build up yield where you can't get some elsewhere. And ultimately, we're going to unwind that. And it's all going to go back into China. All that money's going to go back into Japan. We unlock all of this dollar weakness, and we could see some yuan strength of as much as 10%. There are some really, really punchy calls out there. I think we have to park this conversation about the yen carry trade and just make it really simple. Over the last year, America has been a destination to pick up risk-free yield like you can't anywhere else on the planet. That's where a lot of money's been going.
That said, that was Stephen Jen talking about this and the sort of dollar hoarding that's going to get unwound. Goldman Sachs punched back this morning, and they came out and they said, our gauge suggests much smaller dollar hoarding by exporters from mid-2022 to 2024, talking about external factors driving the yuan appreciation against the dollar, basically saying, we don't see the dollar weakness that you're calling for. This has been the ongoing debate, and it will continue to be going into year-end.
Let's get you set up for the next hour or so. Here's the lineup for you. Coming up on the programme, MacGuineas of the Committee for a Responsible Federal Budget. Following Kamala Harris's first sit-down interview, we'll speak to Jonathan Miller of Miller Samuel on the Vice President's plans for the housing market, and we'll catch up with Jeremy Stretch of CIBC to build on the conversation we're having here on the FX market. Let's give an update on stories elsewhere this morning. Here's your Bloomberg brief. Inflation in France easing to its lowest level in over 3 years, bolstering the case for additional rate cuts from the ECB. Consumer prices rose 2.2% from a year earlier in the month of August, just above estimates. The data coming less than 2 weeks before policymakers gather in Frankfurt for the central bank's September meeting. Elsewhere, shares of Ulta falling in the pre-market, the retail chain reporting earnings that missed analyst expectations and cutting its fiscal 2024 revenue guidance. Ulta CEO saying the beauty category remains resilient, but growth is normalizing after 3 years of gains. The stock is down by more than 8%. And your third and final story, the world's third busiest airport is in line for a major upgrade. The owner of Amsterdam's International Airport is set to invest over $6 billion over the next 5 years. Those funds going to infrastructure upgrades to areas including baggage, escalators and taxiways. I think we need to see some big upgrades stateside as well in the New York region.
We have seen, though, honestly, I'm going to say something very controversial right now. LaGuardia is better than the Amsterdam airport.
Ooh.
It's
Why is
true.
that controversial?
Well,
LaGuardia's had a big upgrade. It's great.
Yeah. Have you been to the Amsterdam airport?
Not for years.
Yeah, it's needing.
I've got a connection at Amsterdam airport before, and let's just say I had to run for it.
Yeah.
Like as fast as I could.
So you didn't actually have time to look around, which is probably
You've had
better.
you had some problems at Amsterdam.
Well, it just...
Do you want to do European airport complaints? Because I've got many. Frankfurt.
Yes.
Frankfurt. My European airport complaint, Frankfurt. I was delayed at Frankfurt airport for hours. Anyone who's been there, there's nothing to do. Literally nothing to do. So I tweet, delayed at Frankfurt airport. The airport tweeted back, I hope you enjoyed it.
The delay?
The airport.
Well, maybe you can...
Hope you enjoyed the I was literally being trolled by the airport. They know there's nothing to do there.
We could talk about that offline.
Haven't been back. Up next, heavy on talk, light on specifics.
My agenda includes what we need to do to bring down the price of groceries. I will not ban fracking. I think it would be to the benefit of the American public to have a member of my cabinet who was a Republican.
More on that suggestion in just a moment. From New York City this morning, good morning. Stocks on the S&P 500 look a little something like this, up by 0.4% in the bond market, the 10-year 385.38. Bit of a snooze in the FX market, euro-dollar 110.80. Under surveillance this morning, heavy on talk, light on specifics.
My agenda includes what we need to do to bring down the price of groceries, what we need to do to extend the child tax credit to help young families, what we need to do to bring down the cost of housing. As Vice President, I did not ban fracking. As President, I will not ban fracking. I think it would be to the benefit of the American public to have a member of my cabinet who was a Republican. This war must end. In the meantime, and we must get a deal that is about getting the hostages out.
The Vice President Kamala Harris sitting down for her first substantial interview since accepting the Democratic presidential nomination. This is a new Bloomberg Morning Consult poll shows Harris maintaining her momentum post-DNC, including in critical swing states. MacGuineas, with the Committee for a Responsible Federal Budget, joins us now for more. Mike, welcome back to the programme. Always appreciate your time. It's always a frustrating conversation for us both because ultimately we both know what's going to happen here. They get into power, they'll do nothing about it. I just wonder from your perspective what the best outcome actually is. Is it a divided government which stops it from getting any worse? Or are we actually still hopeful we get a commitment in Washington, some unity, and they do something about it?
Well, the overall fiscal situation so demands action, but no matter who is president, 2025 is going to be a very challenging year because we have huge expiring tax cuts, which both candidates have talked about extending, and a debt ceiling possible showdown again. So on one hand, divided government often is sort of the best thing for fiscal issues. You can't put in place lots of new promises. On the other hand, right now, we really need to have a debt deal, to actually put in place some changes that would make a difference. The single best thing that could happen for that is that we started talking about it in the campaign, that the candidates felt like they did back in the old Ross Perot days, that they had to talk about this issue and what they would actually do to improve it and started competing on that front. That would create more of a mandate for whoever is in power. But I'll tell you, we're off to a rocky start where both candidates have so many promises that would make the fiscal situation worse. Very light on details on those that would make it better.
Maya, the only thing that would really cause this to be front and center for the campaigns would be if the bond market actually pushed back and created a market problem that really forced the hands of the candidates. Are you frustrated that that's not happening?
I mean, do I want there to be any kind of a crisis that causes action? No. What I'm really frustrated is that our government only does anything when there is a crisis and an action-forcing moment. I would like, as I think most of us would, to have a functioning government that got ahead of these problems. But it does concern me, to your point, that I think the financial markets will be the only things that really push action. And there's a very different time horizon where traders, those who are looking at the bond market and acting there, it's a very short-term time horizon, and it's almost somewhat of a bubble mentality, which if you worried about this for too long and nothing happened, you made some mistakes in terms of how you're investing. We don't know the timing of when rates will go back up, but we know that you can't go on this fiscal trajectory as we have indefinitely without upward pressure on inflation, like we just saw recently, more upward pressure on interest rates, and this high debt load that we have means that the cost of when those rates do go up will be incredibly expensive. Right now, just a 1% higher interest rate than is anticipated leads to roughly $300 billion a year in higher interest payments. So we are very dependent on those rates, and any change there would push politicians to act. I'm not always sure they'd act in the right direction, though. They might still compete about doing the wrong thing because our policy solutions are so off the mark right now.
Before we get into the candidates and what the proposals would mean, I am curious about your view on how the Treasury Department has gone about issuing debt to fund this deficit. There has been some criticism that they have disproportionately issued debt on the front end of the yield curve in order to insulate the long end from any type of volatility. Do you see that as potentially sort of keeping a lid on how much borrowing costs could go up, and thus how much a market really does challenge this fiscal policy?
That certainly could. There is a risk that that's been the situation. For quite some time, people have been questioning the different ways that treasuries have been auctioned and why, for instance, we didn't have longer maturities. A number of years ago, people were talking about issuing, even 100-year bonds. There just wasn't the demand for that. Treasury has always had a very in-depth process of looking at liquidity, maturity, the different trade-offs in the market. But there is always a risk that it becomes more political, those choices that are being made. That said, I haven't seen any specific signs that there's motivations there. And it's the same that there's always accusations that the Fed is doing anything politically, which I think is clearly not the case. So my biggest worry isn't there. My biggest worry is we have two teams in Congress and the president of both parties who really thinks the best way to win the hearts and minds of people is giving them things, tax cuts and spending increases. They keep doing that, and that does put pressure on those who are, managing the stability of the markets, both in fiscal policy and monetary policy, to be sure.
Maya, which candidate right now has a higher debt load that they're basically implying through what they are promising to prospective voters?
Well, I should be really clear. It is absolutely premature to talk about how much both of them would add to the debt in any comprehensive way. And we will, in a month or two, issue a very detailed, comprehensive score of both the candidates' plans as part of our U.S. Budget Watch project. But we're at that point where both candidates have kind of flirted with some ideas, but not committed to them. So you can't put out a real score yet. But if you're looking, former President Trump would add trillions, plural, probably 3, 4, 5 trillion to the debt from his promises so far. And Harris would put closer to 1 trillion. So far, the promises of Trump are larger. A big question when it comes to former President Trump plans is how much money all those tariffs would raise. You have to look at the tariffs. There's a lot of revenue that would come in there, but it would have huge effects on the economy. And a big question when it comes to Vice President Harris is she has promised to extend the tax cuts, but we don't know what that would look like. She has promised to adopt the tax increases in the Biden budget, but we don't know what that would look like. There are trillions of dollars there that haven't been laid out. So the running price tag for both of them, probably roughly 4 trillion for Trump, 1 trillion for Harris, is not at all them having got to the finish line. If I were betting, I'm worried that those numbers will get larger, not smaller, once the campaign moves into the final season.
Mike, just got about 60 seconds. What is your thoughts on this? Taxing unrealised gains. We've heard directly from the campaign about this, but not directly from the candidate with any real clarity. What's your read on what that policy might look like and whether they can actually follow through with it?
I think we won't get the details of that policy because it's incredibly complex. And the closer that you move to enacting it, the more problems start to surface. So I think these will be things that are talked about in generalities in terms of what groups of people want to tax at higher levels. They're going to stay away from specifics because it gets very tricky when you start to talk about how to implement taxing unrealized gains, for sure.
Maya, when you put out that report, come here first. Looking forward to catching up about it. Thank you. Thank you. Maya MacGuineas there of the Committee for a Responsible Federal Budget. The key word, responsible, sort of missing from the conversation.
Well, essentially, as she said, the way people win elections is by promising everyone more. And that's basically what we see in these elections as well. And the question is whether the hand of those politicians will be forced by a market that has been becalmed, frankly, by past history and by the fact that the U.S. is in a unique position.
The privilege of acting recklessly. A privilege other countries don't have.
Some people say that.
Some people do say that. Some people around this table. Coming up on the programme, Jonathan Miller of Miller Samuel as pending home sales fall to the lowest level in over 20 years. That's next. You're watching Bloomberg Surveillance. So we are 120 minutes away from the opening bell. The last day of trading for the month of August, going into a very busy September. Equity futures positive by 0.4%. On the Nasdaq 100 up by 0.7. On the Russell up by 0.5. The S&P 500 actually poised for a week of losses as things stand, but still on course, Lisa, for a month of gains.
To me, one of the most interesting statistics, and we mentioned it earlier, but I want to mention it again, the Magnificent Seven stocks are almost 12% below their all-time peak. You can see right now that is what's holding this S&P 500 from another all-time high because everything else is participating. I wonder how long we can get this reversal and how far it can go, really lifting the overall index if you don't get the participation of NVIDIA.
Does this smell like July? A little bit going into the August report for the month of July. August 2nd, we got this big downside surprise on jobs, unemployment crept higher. We'd been talking in the weeks previously about tech was sort of left to the one side. We've got new leadership coming from the rest of the market. Does it feel like that moment all over again?
There have been head fakes with the rotation trade. How far away is this market from bad news being bad news? I think that's another way of putting the same kind of idea in terms of if we get a labor market report next Friday that's weaker than expected, does that torpedo the optimism that we're seeing baked into some of the recent performance?
Because a month ago, 3-4 weeks ago, we had this period of about 2 or 3 days of just really weak economic data. ISM manufacturing, the employment component, pretty unnerving. Then we saw jobless claims start to break out, payrolls almost reinforcing that view. Ever since then, week after week, economic data in America has been pretty decent. In the bond market, front end of the curve 2-year, 390. Longer end of the curve 10-year, 385.19, 30-year 413.19. Want to spend a bit more time talking about the commodity market. Need to spend some time on that. This came from Michael Helane of Bank of America this morning. The secular shift from a 2% CPI world to potentially 5% means the commodity bull is just starting. Said this, Lisa, 60-40 question mark. Commodities are a better 40. Commodities are, the view from Bank of America.
The idea of what is an inflation hedge, and inflation being a bigger problem potentially than some of the growth concerns that recently would bolster bonds. This, to me, is one of the most fascinating moments for inflation discussions. They've fallen off the map, which may or may not be valid. But at what point do you have to worry about the reignition of inflation at a time where basically this is a Fed, it's going to get ahead of weakness. You don't see much of a slowdown in the overall growth picture. You do see companies continue to earn profits. At what point do we start to worry about inflation again and look for assets that can accordingly balance out those risks?
Odd to have conversations about mission accomplished with CPI closer to 3 than 2. Of course, we're a long way away from 8 and 9, but certainly not quite mission accomplished yet, is it?
Well, it's not mission accomplished, and there are some nodes of inflation that a lot of people dismiss, housing inflation in particular. I am very curious to see that if rates do drop precipitously, does that cause housing to become more affordable or even less affordable, given the fact that lower rates have caused prices to go up? Again, idiosyncratic or a key component of this overall market?
It's my question, too. It's everyone's. Does it have a greater effect on supply or a bigger effect on stimulating demand? And not many people know the answer to that just yet.
I don't think anybody knows the answer to that.
We're going to find out potentially in the next couple of months. We'll have a conversation about it in just a moment. Under surveillance this morning, OpenAI could get another big financial backer. Sources telling Bloomberg that NVIDIA has discussed joining a funding round that would value the AI startup at more than $100 billion. Apple and Microsoft have also been in talks about participating. Remember those conversations about unicorns?
Yeah.
What's a unicorn? A private company with a valuation of more than $1 billion?
Yeah.
$100 billion. That conversation feels archaic now.
Yeah, well, and it's interesting that they're all participating. So it's all of the major companies that would be users of the product of OpenAI. This is a contrarian take. At first, sort of, what's the antitrust pressure and, behemoths that are kind of controlling everything. I'm actually interested to see, are they going to form some kind of commission to oversee the application of AI and to make sure that it's being done in a way that is responsible going forward at a time where we do not have an understanding of exactly how some of this generative learning and machine learning really comes together with the ideas. There is a black box component to artificial intelligence that has created some concerns. We saw that with OpenAI. Do these companies create a sort of reason to be responsible because it doesn't set any one of them back more than the other? Or does it basically cause them to just gun it and go as far as you can because it's going to benefit every one of them, at least, and roll it out faster? This, to me, is actually what I'm watching most closely.
We've had conversations that would last weeks on this programme already this year based on the shovels of the gold rush that is AI and not nearly enough of a conversation about use cases. Surely that's got to be the dominant conversation of the next year. What is the use case? What is the return on investment for some of NVIDIA's biggest customers?
I could not agree more. We are talking about potentially, we've seen this with search, we've seen this with respect to certain efficiencies in scouring through, say, earnings calls and some of the documents that people get, transcripts in terms of keywords. We don't see it in terms of how can you really create the idea of intelligence, analyzing data sets and coming up with predictive models that can be accurate without bias, and what that means in a society that has inherent bias. These are some of the questions that people have.
NVIDIA right now up by 0.9%. Let's turn to this story. One of Lisa's favourites, Lululemon, facing pressure as consumers pull back or go for baggier pants. The athleisure giant lowering its sales and profit outlook for the year thanks to increased competition and lingering inflation. But shares are actually up in the pre-market as analysts see the revised guidance as achievable. That stock is up by 4.5%. I've just gone through all the analyst commentary. Guidance for full year seems to be low and beatable. That's coming from Morgan Stanley, who are still overweight. Price target lowered just a little bit, but you see that almost on repeat from the South side after the numbers yesterday afternoon.
We're going to talk to Dana Telsey coming up, and she has a similar kind of thought. Key question to me is how low is the barrier to entry for new entrants? And we've seen this with Nike and Adidas in terms of disruptors there. And we see this with respect to Alo and Beyond Yoga and Vori, which we've talked about excessively on this program. And there's a question of how quickly are the trends changing and how much lower are the barriers to entry given some of the social media actors, et cetera, and advertising in that vein. Key question to me is, how do you respond to that? Is it a matter of social media placement? Is it the fabrics? Is it style? How do you sort of get ahead of that at a time when, you know, this is a company that's become associated with tight fits?
Fashion comes in waves, right? You see this with certain names that are on the edge of bankruptcy and then 10, 15, 20 years later, they get a new designer and you have a big turnaround and boom, it's the thing of the moment. I'm thinking of, say, Gucci. Look at the arc of Gucci over the last several decades. Lululemon's just not that cool to people anymore. It just feels like it's got a massive brand problem. Burberry may be a better example of that over the last few decades. Remember the 90s where it was just associated with football thugs and then 10, 20 years later, Angela Ahrendts comes on board, Mr. Bailey, the designer, things turn around and then we end up in that soft moment again. Lululemon feels like it's just on the wrong end of a wave right now.
I just think it's a liability when something becomes too cool too quick, because then all of a sudden there are people who don't look for the brands. I'm just saying people who don't look at what the brand is. They actually don't want to be sort of branded by the clothes that they wear. They just want something that's comfortable and that looks good. And then they go for something that doesn't have such a clear association in society. And then all of a sudden things start shifting away.
Great example. And I know you're talking about yourself, so let's talk about you a little bit more. You watch the Olympics loads, right? Just like I do.
Yes.
You're inspired by the athletes. You're very ambitious, driven, aspirational, goals-driven. All of that. I totally get it. You work out a lot, physically in fantastic shape. At any point, after experiencing that moment after last month, did you go on the Nike website and think about getting some new sneakers? Did you think about going to Lulu and buying some new workout gear?
No.
That's a massive problem. That's a huge, huge problem.
Yeah. How do you associate a clothing brand with some sort of fitness that we all aspire to?
I think that's the most complimentary I've ever been of you. So there we go.
Very
Leave that
sweet.
there. All right.
Yeah, let's just be really honest. None of that's actually true, but carry on.
Lisa runs home every single day.
I do.
Vice President Kamala Harris telling CNN that economic issues will be top of mind, quote, from day one if she wins the presidency. That would include house affordability. Harris reiterating her proposal for a $25,000 tax credit for first-time home buyers for down payments. Jonathan Miller of Miller Samuel joins us now for more. Jonathan, Lisa and I were both looking forward to this conversation. Before we get into the policy from the Harris campaign, I want to start with the policy coming out potentially from the Federal Reserve. A key question we've all got, and we'd love your opinion, whether the effect would be greater on unlocking supply or stimulating demand. How are you thinking about a reduction in interest rates?
I'm thinking about it as a wash, that the idea that we're going to have more inventory come in with lower rates is going to be offset by the increase in demand. I don't think the picture changes that much from where we're sitting right now. And it's interesting because so much of the economic commentary surrounding housing is amazingly out of date just because of the yen carry trade situation in early August. It seems like years ago, but it's very sudden. And so all the data like pending home sales is showing a sort of a prior moment in economic history, I think.
Jonathan, can you tell me then your view on rents? Because I know rents, particularly in New York, things are really quite punchy. When it comes to unlocking maybe demand for purchasing, do you think we can unlock some supply for rents? Because the people that have been trapped in renting properties, particularly here in New York, and I'm getting personal now, do you think some of those properties will ultimately be left and available for people?
I do think that as rates come down, that the pressure will soften. And the way to think about the rental market and the purchase market as competitors, and we've seen rents really pushed higher because over the last 2.5 years, mortgage rates have really jumped, and that has tipped the balance, pushed people in. I don't see this as a correction in rents. I see this as a slowdown in growth or stability in rents, maybe some decline, but certainly the tenants aren't going to be sort of realizing a tremendous influx of new affordability. I think this is a long grind.
Yesterday, U.S. pending home sales dropped to the lowest on record, or the gauge that tracks them. How broken is this market right now, Jonathan?
Well, it's extremely challenged, and I think the pending home sale data that came out doesn't reflect sort of buyer minds, buyer attitudes that were changed in the early part of August with a sort of a reflection on what recession risk is and what the Fed is going to do. I mean, after all, we're seeing in New York, for example, an uptick in contract activity disproportionate to the season. And you have to remember that consumers have been waiting for 2.5 years to make a decision. And it appears that what we're going to see, not just in New York, but nationwide, is as rents soften more because of lower mortgage rates, as more people go into the purchase market from the rental market, that we're also probably going to see rising housing prices as a result.
This is what we've been asking, exactly that, Jonathan, this question of will lower rates cause prices to go up or affordability to go up as well, right? There's sort of two ideas. Will it get cheaper for people to buy homes, or will it become all in more expensive because even if rates are lower, the overall asking price and achieving price is going to be much higher? You sort of alluded to it. You think the price is going to be significantly higher.
I don't know about significantly, but I think the trend is we're going to see price growth continue. We are seeing more inventory come in. Some parts of the country are seeing more than others, but it is in a good part of the country, inventory levels are still well below pre-pandemic. And in those markets, you're going to see more price growth than you will in markets where inventory is at parity now.
There's this real question here about the pace of declines in benchmark rates and who it unleashes first, the supply or the demand. We've been talking about this. How low do benchmark rates have to go to unleash the supply? People who want to leave their homes, whether it's people who are retired, no kids, big houses, they want to downsize, or whether it's people who had kids and have no space and want to move, but have been locked in by their mortgages, whichever one you happen to be in. From your perspective, what is that rate? And does that unleash supply before it unleashes demand, or vice versa?
Right, it's sort of like a dance we're trying to orchestrate here. The way I think of it is, I think of it as it's incremental change, but once we, the rates, like on a 30-year fixed, drops below 6%, if that's the case, I think visually that will have sort of a jumpstart effect to demand. I don't think the thing that I'm sort of conveying here, I'm trying to convey, is that I do see it as an offset for all the new inventory that comes in. I think we're going to see an increase in demand because both buyers and sellers are aware or looking at the rates. A seller that has been reluctant to list is going to become a buyer, and the lock-in effect that was holding them back. They've had 2.5 years to sort of think about it, and at some point, personal situations require action.
Jonathan, appreciate your time. Thank you. Jonathan Miller there of Miller Samuel on the housing market. He's talking about a long grind. Let's talk about the long grind. So when we talk about the lock-in effect, I think lots of you already know what we're talking about. The people like Ramo with very low interest rate mortgages who are basically locked into their home aren't going to sell anytime soon, because why would they take on a mortgage with an interest rate of around 7%? So the effective mortgage rate right now, which in America, ultimately we're talking about the average rate on outstanding mortgages, is 3.92. In 2022, essentially when the Federal Reserve started saying, hey, we need to start raising interest rates aggressively, that rate was 3.31. So the average rate, the effective mortgage rate in America has moved about 70 basis points in the last 2 years. That's the slow grind that Jonathan's talking about.
Yeah, as evidenced by the fact that home sales are falling off a cliff. They haven't revived. The fact that mortgage applications, sure, we saw a little bit of an uptick, but otherwise are flat on their back. Because why would anyone move or even sell if they know that they're going to get a lower price and they're going to have to get a higher mortgage rate to go in anywhere else? This has been the conundrum. How we unlock that map process is still somewhat of a mystery as people sort of understand that dance.
Takes a while to close that spread. We're starting to close that spread. Let's see how quickly we can close it. Equity futures right now on the S&P positive by 1/3%. The opening bell 1 hour and about 45 minutes away. Let's give an update on stories elsewhere. Here is your Bloomberg brief. Bloomberg reporting that Intel is working with investment bankers to navigate the most difficult period in its 56-year history. The chip maker said to be discussing a range of scenarios, including a split of its product design and manufacturing businesses, as well as the potential scrapping of some factories. That stock is up 3% in early trading. Dow shares trading higher in the pre-market. The computer hardware company reporting second quarter results that beat expectations, with particular strength in orders for AI servers. Dow forecasting third quarter sales in line with analyst estimates. That stock is up by more than 4%. And third seed, big upset at the US Open. Carlos Alcaraz suffering a shock defeat in the second round, falling in straight sets to the world number 74. The Wimbledon and French Open champion making his earliest exit from a Grand Slam since 2021. Big shocker in the last day.
Okay, no one wants to see my workout routine. They all want to see Alcaraz's workout routine, because that's way more interesting than anything else going on over here.
There was a first-round qualifier, I think, who played Carlos, who called him a specimen, quite a specimen.
Indeed.
Dude's jacked.
Yeah, well, okay.
Absolutely jacked, but he's gone home early, much earlier than we thought he would. Up next on the program, pressure building on the US dollar.
The dollar has clearly weakened in the last 5 weeks against the majors. As long as you continue to see better growth overall, there will be a strong bid for the dollar.
That's next. This is Bloomberg TV. Stocks are firmer to close out the week, up by 0.4% on the S&P 500. The dollar just a little weaker on the session. The euro 110.86. Under surveillance this morning, pressure building on the dollar.
The dollar has clearly weakened in the last 5 weeks against the majors. One of the reasons this has happened is because the Fed has moved in a much more towards a much more dovish narrative in the last few weeks. Culminating with Powell's speech, but the European Central Bank and the BOE have not. Is the dollar going to continue to weaken against those majors? I would say no, despite the fact that we are seeing a lot of dovishness from the Fed at this moment. As long as you continue to see better growth overall, there will be a strong bid for the dollar.
So here's the latest. The dollar on track for its biggest monthly loss of the year, with markets bracing for a Fed rate cut next month. Jeremy Stretch of CIBC writing, with the easing cycle approaching, we think we are near the end of the recent multi-year period of dollar strength. We do still like dollar upside because of our view that 50 basis point cuts are not needed at this point in the cycle. Jeremy joins us now for more. Jeremy, welcome to the programme. Just to give you the opportunity to build on that just a little bit more, the dollar bull market might be over, but ultimately you still think there's a little bit of juice left to squeeze. Explain that.
Yes, I think there is a little bit of juice left to squeeze. We obviously have more than 25 basis points priced for the September meeting. So I think that's where there is a little bit of a residual risk. So I think it's clear that we've seen a significant and substantive dollar sell-off through the course of the month of August. But I think we can and should see a little bit of a correction back towards maybe 102 in the DXY in the nearer term, because I think the data doesn't warrant any concern regarding a 50 basis point adjustment from the Fed. I think we're looking at purely standardized 25 basis point moves through the rest of this year at the next three meetings. And I think that will eventually provide some sort of dollar cheapening. But I think we've moved a little bit too far. We're seeing a correction. That correction probably has a little bit further to go. Euro dollar got overbought, as did sterling. And I think it's a case of looking for better levels to enter trade. So I think it is going to be the case that we see a little bit of a dollar recovery first, but then we start to see a generalized bid towards those higher beta currencies, which will benefit from the stronger growth trajectory that we're expecting into 2025.
Jeremy, it's been quite a month for the FX market. August 2nd, August 5th, I think is best described as a positioning shock. Just how clean, and I know it sounds a little bit cliche, but how clean is positioning now? How big is that dollar long still?
You're absolutely right. We have seen a very volatile period. We've seen a substantial repricing or re-examination of holdings in yen, for example. Clearly, that's been a big shift and a big structural deviation in terms of moves. We still have some fairly large structural positions in currencies like the CAD, for example, which is still incredibly short overall. But we have seen a generalized paring back in terms of those dollar holdings. So we are, I wouldn't say we're clean, but we're certainly less skewed in terms of aggressive positioning biases than we were certainly at the beginning of the month, as we are now coming into the end. But of course, we have this long weekend in North America, and then we will be very much focusing on next week's non-farm payrolls result.
Jeremy, all I can think about, maybe it's because we're right ahead of a long weekend, but all I can think about as you speak is it's never going to be this cheap for U.S. residents to travel overseas again. You can play it around the edges, but essentially that's what you're seeing, that it's going to become more normal in the future, even at a time where you could see some strength on the margins as we head into a volatile, choppy couple of months. Is that right?
Yes, that's right. I mean, I think it is very much the case that obviously on a longer term basis, the dollar has performed relatively well. We've seen a prolonged period of US economic exceptionalism. That's really amplified dollar valuations, and so dollar resilience has been very much the case. So for those US domiciled tourists, the dollar has gone an exceptionally long way across the world over the course of recent years. I think it is going to be the case over the course of the next couple of years or so that we are going to see a graduated moderation in terms of those dollar valuations. And I think it is going to be the case that also the exceptional sort of dollar performance, which has been supported by that reserve currency status, although we won't be marginalized, it will be the case that there will be a gradual and continual long-term diversification away from those dollar holdings, which is a longer-term but gradualized process which will limit those dollar valuations.
The only fly in the ointment here is where else are people going to put their reserves, whether it's a central bank or whether it's an investor, considering the fact that there aren't a lot of great alternatives. It doesn't look like the euro region is poised for significant growth. Potentially the ECB could cut as much as the Federal Reserve. Where will that strength come from?
Well, you're absolutely right that is the problem that central bank reserve managers have, that yes, they may wish to gradually manage down those domiciled dollar reserves, but the alternatives are not particularly encouraging or not particularly widespread. So that, in a sense, has been one of the reasons why the dollar has held on much longer than would otherwise have been the case when you consider the fiscal and current account shortfall. So I think it is going to be a very slow and graduated process. We have seen a modest pickup in terms of those euro reserve holdings from the lows that we saw during the eurozone crises. We're a long way away from the sort of extremes that we were seeing in 2008 and 2009. So there is scope for a moderate pickup there. But of course, as you say, the ECB are going to be easing, although I don't suspect that the ECB will be easing at quite as fast a pace as the Fed. So I think that's certainly something to keep in mind, that we are expecting another 50 basis points from the ECB, but it's going to be a slow and probably a quarterly process as far as the ECB are concerned in terms of policy easing, so not as aggressive as we anticipate for the Fed.
Interesting. Jeremy Stretch of CIBC, thank you, sir. It's going to be the question I was going to ask right at the end there. Who eases more in the next 12 months, the ECB or the Fed? And Jeremy's indicating it's going to be the Fed.
Well, and this is the reason why you're seeing the ongoing potential for weakness there. I just wonder if that's true. Look at the data out of the Euro region. What incentive does the ECB have not to lower rates more than the Federal Reserve? Honestly, I don't see it.
I feel you. But single mandate central bank. They've got to talk a certain way about inflation.
Talk, but act is a different maybe story.
We'll see. We'll see. Up next, Eric Freedman of US Bank, Dana Telsey of Telsey Advisory, Rob Sockin of Citi, Gennadiy Goldberg of TD. From New York, this is Bloomberg.
The AI cycle is absolutely happening, and this trend is still very much ongoing.
You need to see some major shift in earnings dynamics or earnings leadership to see tech take a big step back here.
The bigger story has been some of the broadening out that we've seen in the market in recent weeks.
We're actually starting to see more stocks in the S&P 500 post positive year-over-year earnings growth now.
The need to rely on a single stock to power the market, I think, is diminishing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Snoozy morning so far. Things get a little bit busier over the next 90 minutes or so. So let's get straight to it. 30 minutes away from economic data in America, 90 minutes away from the cash open. Let's start with the scores. Equity futures on the S&P 500 firmer by 0.4%, up by 0.75% on the Nasdaq 100. The outperformance yesterday belonged to the Russell, the small caps, the equal weight on the S&P, another all-time high. The small caps up by 0.5%. There are your scores, some of the price action. Here's the next few hours, your day ahead. 8:30 Eastern Time. We get some personal income and spending data, core PCE. Then later on this morning, 10 a.m. Eastern Time, UMich consumer sentiment.
All we could say is that yesterday what fueled the rotation, at least at the beginning of the day, was this idea that you got the second read of the GDP that came in stronger than expected. I mean, yes, it is that kind of day or that kind of week where that's the kind of data that will really shift markets. And you saw initial jobless claims that didn't go up. It was the perfect recipe of immaculate disinflation. If we see inflation come back, suddenly will people care about some of these inflation rates that we're having coming up that otherwise have been written off as just a second side story to what we're seeing in the labor market?
Yesterday was a pretty odd session, wasn't it?
It was.
We had the Nvidia news earlier in the morning. The stock was low and then it started to recover. The broader market was doing nicely, particularly after that economic data. Then it all faded into the close. Nvidia actually closed yesterday. If you are just joining us and maybe you slept through the close yesterday, down by about 6% at the close in yesterday's session.
Which is remarkable considering that we didn't see a bigger decline on the S&P, right? I mean, the fact that the other stocks did retain their lift. Yes, you saw Nvidia sell off. Yes, you saw several of the other tech stocks also fall out of bed. Otherwise, you saw resilience. And to me, that was the biggest story yesterday, even with a decline into close. This idea that people still believe in the recovery story. What would it take to shatter that? How much of a decline, let's say, in the headline labor market data? Or what if we see a revival in some of the inflation rates?
You'd have to see bad data. And we did not see bad data yesterday. Just reinforced this view that the economy was in an OK place. Equity's doing OK, up by 0.4. Welcome to the show. If you are just joining us, let's look at the bond market. In the bond market, we are poised for a fourth consecutive month of falling yields at the front and back end of the yield curve. The two-year yield, Lisa, still in at around 390. It's been a bit of a grind over the last month or so, but that grind continues.
Jay Powell just said it. I'm going to cut rates. I mean, he didn't say that, but he said, you know,
he
basically did. He said, you know, the time has come, which is basically we're going to cut rates. The time has come to start adjusting policy and talking about how no further weakening in the labor market would be welcome. They would like to see this labor market remain where it is right now. Given that, it makes complete sense that there is this rush into U.S. bonds. And we did see something like the 36th weekly inflow into bonds led by U.S. government debt. Question is, at what point do we see the long end start to perk up some other issues? We saw yesterday a messier 7-year auction, exactly as we expected. A little bit more pushback when it comes to longer-term expected rates and understanding what the discount rate should be, what the idea of the fiscal overhang and some other pressures should be for longer-term U.S. rates.
We'll spend the next hour getting you set up for the jobs report next week on September 6th. I can share the estimates with you right now. 163 is the median estimate in our survey. Those numbers just coming together still, but the unemployment rate is interesting. 4.3% at the last report, which unnerved a few people. Looking for that to come back down to about 4.2. So some questions and answers potentially on that through the next 60 minutes or so. This is your lineup. Coming up, Eric Freedman of US Bank as markets await core PCE out in just under 30 minutes' time. Dana Telsey of Telsey Advisory Group as Lululemon contends with consumer pressures and baggier pants. And Rob Sockin of Citi on why he's still expecting a soft landing. We begin with the big issue. Good news is good news. Stocks inching higher as data shows the economy is in seemingly good shape. But Eric Freedman of US Bank staying cautious, writing solid consumer spending and labour market dynamics continue bolstering economic growth and corporate earnings, but have both decelerated somewhat. Slightly constructive market signals and near neutral macro signals continue to warrant a cautiously optimistic bias towards equities. Eric's with us for more. Eric, welcome back to the show. It's good to see you, sir, as always. You manage client money, institutional money totaling, I think, something like $500 billion. Can you share with us how much of that has been in cash, just sort of lazy money getting rewarded in money market funds, and how much of that has started to be deployed over the last month or so?
Yeah, Jonathan, in a way, it's almost been like this nostalgic push from both institutional and wealth clients, just viewing that, hey, look, I can actually get something from the shorter end of the curve, so I'm going to stay there. And I think that, we saw balances go up as high as 10.5% in cash. And that's really worked its way down to about 4.5 or 5% across our broad book of business. So that says to us that, look, investors are getting this idea of a repricing across the curve. And I think that effective pivot in Jackson Hole last week was all of the, just the consensus view that, hey, look, we're not just going to have that nostalgic view in perpetuity. So we are seeing more of a gradual, let's call it, filtering into other parts of the marketplace. I thought Lisa had a really nice tweet, or X, whatever you call it these days, regarding flows into bond funds. We're seeing that. We're also seeing, though, an extension in other parts of the broader global macro trade. So that's been a positive. We think that probably continues for the next couple of months.
I think we just go with post. I think just post just works, but whatever. Eric, when that cash position comes down from, say, 10 to 4.5, 5, how sticky is that 4.5? Because certainly people are lining up on this programme telling us that money's going to be deployed, Fed's going to cut interest rates, curve normalises, you'll see that curve go out the curve and into equities elsewhere beyond fixed income. How sticky is that 4.5 from your perspective?
Yeah, we think it's pretty sticky. I think that the thing that would probably shift views out of that, hey, let's get back into the broader macro ecosphere, if you will, would probably be the idea of the back end of the curve really ripping higher. That's something that your team has done a really nice job thinking about. Like, what are the factors that would actually cause interest rates to go higher on the back end? We don't think there's necessarily an immediate catalyst. There's so much focus on when does the Fed start cutting, how deep will that be for the next couple of quarters. But we do think that what's on the horizon, as we get hopefully more specifics on policy, is the risk that inflation actually picks back up again. That's not something that I think is really being discounted in commodities. It's being something that we think is probably worth talking about as we get deeper into the third quarter and early fourth quarter, probably September 10th, when we have the first and maybe the only presidential debate. There will hopefully be a little more specificity about tax planning and also about spending planning. That could be the catalyst that sets up some of the noise away from Fed and the immediacy of rate cuts and into more of the, let's call it, the inflationary considerations of policy, which we think is it's an undiscounted risk right now.
So just to put a bow on this, Eric, and I think these are all really interesting points that kind of challenge the idea that there's $6 trillion of assets in money market funds just waiting for the Fed to cut rates, and then that's all going to be unleashed into longer duration bonds as well as into stocks. It sounds like you're kind of challenging that, and you're saying a lot of this is very sticky. We actually saw the biggest month of inflows into cash-like funds over the past week, going back throughout the entirety of this year. You're saying that unless long-end yields go higher, that's going to probably stay, and that any kind of optimism you have has to come from elsewhere. Is that a correct characterization?
Yeah, it's very, very succinct and much more eloquent than I put it, at least. I think if you look at fair value, we think for the 10 years, probably closer to like 4%. We're at 385 right now. So in a way, it's almost like duration is too expensive to buy more of, but it's not too expensive to sell. We're kind of in that middle ground, if you will, where 10s, 20s, 30s, probably not a lot of issuance. Again, you did a good job of covering the auction yesterday. If you look at the net participation of buyers across most auctions, it has not been foreign buyers. So who is going to be the marginal buyer of longer term paper? Probably not the usual suspects, if you will. So again, with the 10-year at 385, we think fair value again is closer to about 4. We're in this position where without a lot of definite policy agendas from either party, we're in a bit of a no man's land, if you will, with that trade. So duration, we think, is probably a little pricey. We think that the unwind of cash probably goes elsewhere, and that will probably be more of a trickling type of phenomenon over the next couple of weeks and months.
To take this a step further, Michael Hartnett over at Bank of America was talking about swapping out commodities in place of bonds in the 60-40 portfolio because of some of the concerns that you're talking about. I don't know that you're going to say, 60 should be all commodities or whatever, what have you. But there's a question of whether you start to, on the margins, shift more into inflation hedges like commodities in lieu of some of the bond holdings.
Yeah, Lisa, I think it's a great point. I mean, if you look at the considerations on commodities, when you're in an environment like this, again, we run relative performance money. And so you're giving up about 35 or 40 basis points a month if you're invested in commodities versus bonds. That's a pretty big hurdle for an investor like us to think about. Now, one of the things that has really not worked, in fact, one of the few dislocations in markets right now is the petrochemical cycle. If you look at what's happening with things like natural gas, which is effectively known as the widowmaker for investors because it's so hard to trade, and also things like oil and other components of petrochemicals, you're in an environment where the carrying cost of being wrong is extremely high. So we don't think that now is the time to necessarily be really bold and take a huge amount of capital into commodities, but you can piece into it. Again, gold's really worked, silver's really worked, but industrial metals, petrochemicals have not worked so well. That could be interesting. Again, we'd be very incremental here, especially as you look for optionality on policy risk coming out, later this year. But again, you have to be mindful of that carrying cost, which is quite high.
And that's the reason why some of maybe the 40% of fixed income would go toward that, but not the whole thing. When it comes to the 60% or maybe even higher, if you are bullish on stocks, I am wondering how you are cautious at a time where the risks are bifurcated in nature. What does that mean in terms of how you're approaching allocations right now there?
Yeah, this is a space where, we are actually modestly overweight domestic equities and overweight equities overall in our portfolios. We've expressed that since late April. In equal weighted S&P, we were early, which means we were wrong. In the last couple of months, we've been right, which has really, again, been a benefit. But we think this is an environment, Lisa, when there's just not that much dislocation. Again, since you had the low print in the S&P at 9:31 a.m. on August 5th, which just spoke to how aggressive the position squaring had to be, there just has been such a quick reflexive move upward across all assets that this is about relative value. So again, we like stocks over bonds. We like equal weight over ag. We like equal weight over munis. But, you have to, we think, kind of pair off as opposed to looking at large, deep dislocations that just aren't there in the marketplace. So we're cautious about taking really bold moves. We do think that collecting income is an interesting thing to do for investors. So things like municipal high yield, things like non-agency mortgages, even things like reinsurance and closed-end funds. That's a good way to pick up carry and kind of wait for more specificity without taking in a ton of directional risk, because there just really isn't a lot out there from a market dislocation standpoint to pick through besides, again, commodities, which just haven't done very well.
Equal weight has certainly been working. Just to put a bow on it all, Eric, we've been asking this question all week just to set us up for Payrolls Friday this time next week. Are we just as vulnerable going into September 6th as we were going into August 2nd, or have things changed?
I think things have changed, Jonathan, in the sense of, again, that the taps on the shoulders with yen carry trade positioning, those have already happened. Now, again, investors have very short memories, and so we're not, naive enough to think that there isn't some, potential for being offsides. But again, to your point, if we saw something beyond consensus, which I think is like for a 160, 165 print. If you'd have to see something like sub 110, 100, we think, with also a pretty, not sharp rise, but let's call it a headline unemployment rate of north of 4.5, or 4.4, 4.5%, that would signal a little more weakness than perhaps is priced in. We don't think that's our base case. Our economics team is a little more bullish on what the print may look like, but I think that with positions squaring a little bit tighter than where it was back in the August print, we're not as vulnerable, but it would take, we think, a pretty significant downside surprise to drive markets much lower.
That would be bad news, and that would be bad news. Eric, thank you, sir. Eric Freedman of US Bank. Have a good long weekend. Sub 100K, unemployment at 4.5. Bad news is bad news.
That would mean that, yes, people would price in a 50 basis point rate cut, but they'd also price in a lot more weakness and maybe a challenge to this rotation trade at a time where these are the most leveraged companies to the cyclical cycle.
Might get a rally in bonds, but maybe not in stocks. Equity futures right now up by 0.5% on the S&P. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. The latest Bloomberg Morning Consult poll showing Kamala Harris leading or tied with Donald Trump in each of the 7 swing states. The poll also finding the vice president narrowing or reversing Trump's advantage on key economic issues. Elsewhere, the US labor market is seen as growing just 0.4% every year through 2033, according to new Bureau of Labor Statistics projections. The annual rate translates to about 55,000 jobs per month and is less than a third of the pace of the preceding decade, with the main driver being slower population growth. And finally, McLaren will look to close the gap on Red Bull at the top of the Formula One standings when the Italian Grand Prix is underway in Monza this weekend, the Temple of Speed. McLaren's Lando Norris needs to make up a 70-point gap to championship leader Max Verstappen with just 9 races remaining.
Okay, I noticed a real bias in some of the stories that we've been playing for the third towards specific teams and sports. McLaren.
I didn't even mention Ferrari.
Yes. Okay. Well, there you go. You just mentioned it. Monza.
You've encouraged me.
Just in general, the Temple of Speed. Just saying.
The oldest racing track in mainland Europe.
Not that you know anything about it.
One of the fastest too.
Yeah.
It's a beautiful thing.
It's also like Florida. It's like Miami, right?
Yeah, just like Miami and the Vegas racetrack. Yeah, so much heritage. Up next, the morning calls. Dana Telsey of Telsey Advisory Group as Lululemon grapples with a softer consumer. That conversation up next. It's a racetrack in a parking lot of the Hard Rock Stadium in Miami.
Okay, all right. Please write in with your thoughts on that.
Been chewing over this for the last 3 minutes now. Okay. Equity futures right now on the S&P firmer by 0.5. Let's get you some morning calls. First up, Loop Capital lowering its price target on Dollar General to 90 from 130. Talk about catch-up. The analyst saying the company's Q2 results were worse than expected and management's guidance cut was surprising. Cratered yesterday. Next up, UBS lowering its price target on Guess the 22 from 24, keeping a neutral rating after a tough quarter. The analyst seeing more headwinds on the horizon. And finally, Morgan Stanley lowering its price target on Lulu by $3 to $3.26. The analyst saying full-year guidance seems to be a low and beatable bar. Sticking with Lululemon, Dana Telsey of Telsey Advisory Group, maintaining an outperform rating following earnings, noting solid results and saying a reduced outlook comes as no surprise against moderated expectations. Dana joins us now for more. Good morning to you.
Good morning. Thank you for having me.
You've been busy. How many companies under your coverage have reported this week?
We had 22 companies report this week.
Wow.
Don't tell me about a slow week this week. It was anything but slow because we now have the pulse of the consumer.
Let's pick up on that word slow. How slow are things?
Things have slowed down. You want to call it discerning, you want to call it more cautious, whatever it may be. July was a weak month. August is definitely a little bit better, but the planning for the back half of the year has taken a tick down. And you look at the fourth quarter where you have 5 fewer days between Thanksgiving and Christmas, retailers have to plan cautiously. Some have called out, is that a 3% hit to sales in the fourth quarter because of those fewer days? It easily could be.
So this is the confusion that I'm having. You had personal consumption that was revised up in the second quarter. You have certain companies that are doing just fine. You see travel that still is going pretty strong. Where are we seeing the bulk of this weakness?
In a couple places. Look what you've seen with luxury spending. Luxury spending has slowed. You're not getting the international tourists come over. You're looking at discretionary spending in the department stores. Look at some of the Macy's numbers, the Dillard's numbers. They're weaker than expected. Look at Urban Outfitters. You have consumers that are intentionally spending, and innovation is driving demand. It's not everyone. Look at Birkenstock. They had very good results, double-digit increases. Take a look at Abercrombie. Hollister accelerated. You're still seeing strong double-digit gains at the Abercrombie brand. Look at footwear. Deckers, On Running. You've had innovation and newness drive demand. But look what you've also had. The off-pricers outperformed. 4% comps at TJX and Ross, 5% comps at Burlington. Look at Walmart and Target. The consumer's searching for value because they don't have the stimulus dollars they had a couple years ago.
This might be a bridge too far, but is this a lot of people who are higher income searching for more value, but the lower income families still actually really struggling? In other words, are we getting a signal from the fact that off-price places are doing well, but the Dollar Generals of the world are flat on their backs and can't get a break?
And it's a little bit of everyone. I mean, you take a look at the Dollar Generals, but look who's taking share. The Walmarts, the Targets, the Ross, the TJs, the Burlington, they all did well. Some of the dollar stores, they're cutting back on their rate of new store openings, Five Below being one of them. So it's more competitive. You take a look yesterday, Old Navy, and that search for value, it definitely feels what you mentioned. Every income level has turned the needle up a little bit on searching for more value.
Let's get to Lulu. Why is it up in the pre-market? Why is it rallying?
The reason why, because when you take a look at the reset guidance, the stock's already been weak. It's taken into account this already. And frankly, the guidance they gave wasn't worse than some of the whisper numbers out there.
So it's beatable, which is what we've heard from other analysts as well. Let's talk about problems. Where are they having problems?
It's
competition,
the women's
execution,
business.
what is it?
It's the women's business. It is definitely a little bit of the execution of it, the newness in the product that's come out. And you can call newness in terms of colors, it's colors, prints, patterns. They need more of that. It's going to come in slowly. They redid the merchandising structure, and it sounds like they'll be able to react faster and drive more newness into the assortment.
How low has the barrier to entry gotten? I mean, we talk about competitors. We talk about Alo or Alo or however you want to pronounce it. You've got Beyond Yoga. You've got Vori. You've got some of these other brands that have more of the air of cool. And Lululemon no longer does. It's very sort of characterized in social society as like what it is. It's tight. It's a certain person, et cetera. Is this getting easier in terms of disruption that we're seeing more broadly?
I think there's always been competition. I think that all the competitors, everyone has their own personality, so to speak. I think of Alo as fashionable. I think of Lulu as technical functionality. I think of Sweaty Betty as affordable. So each of them has their own pulse, and you have to be able to cater to who stay in your lane and cater to it. The fact that Lulu didn't have that newness in women's impacted their ability to drive conversion.
There's also a question going forward of how much is the weakness something that's just beginning at a time when we just got a note from Andrew Hollenhorst over at Citigroup talking about how he expects the savings rate to fall to an all-time low, that essentially people are spending what they've got left. They've already spent up the pandemic savings. How much do you expect this to be the last gasps rather than the weakest spot?
I don't think it's necessarily the last gasp. I think that their customer has money. It's where they're going to spend that money. Look at the experience versus goods element that's out there. The other thing that you have changing out there, look at other categories that have underperformed. Look at jewelry. Jewelry's been a weak performer. So they'll go there, but they have to see something they don't have in their closet already.
You know what I think of when I think of Lulu? Midtown uniform. I don't think of technical performance at all. I feel like that died in the pandemic, didn't it?
No, I think that people are basically still wearing technical and functional. I think that some of Lulu's merchandise, particularly for men, that ABC pant, that's showing up to work every day.
That was my point. That was exactly it. You picture the Midtown uniform. You picture athleisure during the pandemic. You don't picture, you don't picture Alvarez.
I sense you disagree, Dana, but I just feel like there's been a real brand hit over the last few years. That aspirational gloss is sort of is off.
There's been more competition. They've gotten to a bigger base, so it requires more to beat the bigger base.
Got it. Dana, it's good to see you.
Good to see you too.
One of the
Thank
best.
you.
I know, just an incredibly busy week for you. So
thank you.
Thanks for dropping by.
Anytime.
Down to Telsey of Telsey Advisory Group. Coming up next on the programme, we'll speak to Rob Sockin of Citi ahead of payrolls next week, and we'll catch up with Gennadiy Goldberg of TD on this bond market. Equity futures right now on the S&P 500 firmer by 0.5%. In the bond market, yields up a single basis point at the front end of the curve, 390 on 2s, on 10s, just about unchanged at 385. And as the dollar heads towards one of its worst months of the year so far, the dollar against the euro just a little weaker again. Euro dollar 110.84 from New York City. You're watching Bloomberg TV. Stocks on the S&P 60 minutes away from the opening bell and seconds away from some economic data in America. The scores look like this: up 0.5% on the S&P, up 0.8 on the Nasdaq, up 0.6 on a Russell. The small caps doing okay in the bond market. 2-year, 10-year, 30-year at the front end of the curve. The 2-year 390, the 10-year 385, with some economic data, personal income, personal spending, PCE. Jobless claims was yesterday. We'll get more claims and jobs data next week. Mike McKee's going to be a busy man. Mike McKee, are they late again?
Well, they're a little bit late again, but here it comes. Personal income stronger than expected, up 0.3. Spending comes in as forecast, up 0.5%. PCE price index as forecast, up 0.2. That's up from 0.1 gain the month prior in June. On a year-over-year basis, headline at 2.5%. Core PCE up 0.2 for the month and up 2.6% for the year over year, which is interesting because the forecast had been a 0.2 rise, but a 2.7% increase for year over year. So that comes in a little bit better. Does it make a difference to the Fed? Probably not. These numbers come in pretty much bang in line. The news about personal spending, and we'll dig into that a little bit in a second, is good news in the sense that it suggests soft landing still in place. The question we're going to have is, how do people pay for this if everybody says that their personal savings are gone from the pandemic? I got to look at what the overall wage and salary numbers are in this.
Is it fair to say that with very few exceptions, ever since that August 2nd payrolls report, the data in America has been in line and pretty decent?
It has been in line, and I don't know whether, and I'm sure our guest will say that economists are getting better, but we had a lot of problems coming out of the pandemic, and now it seems to be a little easier to forecast. We're seeing much more in line with what the forecasts are.
Market's pretty snoozy here. No big moves off the back of this. Equities up 0.5% on the S&P, still up 0.9% on the Nasdaq 100. In the bond market, just to touch base with things in fixed income, the 2-year up a single basis point, Lisa. The 2-year 390.
We knew this was going to be basically bang in line with expectations since economists have been doing this. My main question actually coming from this was something that Andrew Hollenhorst pointed out earlier in a note where he talked about how this ongoing spending, which we saw yesterday in the revisions to second quarter, means that savings rates are going to be coming down quite considerably. This is my question. How much are people basically spending and using what they have, not necessarily extra income or extra savings left over from the pandemic?
We'll come back to Mike for some more details on those numbers. Around the table with us, Rob Sockin of Citi. Rob, your thoughts on all of this, where we are and where we're going?
Yeah, it's a very interesting set of data. I think, as Michael was saying, feels pretty soft landing-ish for most of the data that we've gotten in August, outside of the early August period where you had that ugly ISM manufacturing, that ugly jobless claims, that ugly payrolls report. Since then, you've had strong retail sales, much lower jobless claims, revised consumption GDP that showed a more resilient consumer, and pretty good numbers today on the consumer side, alongside pretty good numbers on inflation. So to me, this is a pretty good mix of data. Now, there are those downside risks, of course. The unemployment rate's much higher in that last report. So we have to watch these things closely, particularly in the labor market. But overall, I think a pretty good tone of data.
We say things like this is a soft landing. By definition, it's just a moment in time. And I just wonder what gives you encouragement or confidence that we stabilise around this kind of new equilibrium? Why is this the new normal?
Well, I think that's exactly the challenge. Is growth was always going to moderate from where it was running in the second half of last year and earlier this year. We were running well above trend, and we're at an inflection point, and it becomes difficult to know, are you moderating into a soft landing, or are you moderating and then slowing down much more sharply? So, I'm watching a lot of the higher frequency indicators to tell me where that trend is going. Right now, jobless claims is a good example. They're staying pretty low, so I don't see a lot of deterioration. To me, that says more of a moderation than a sharp slowdown, but history tells you these things can turn pretty quickly, so you don't want to get overconfident. But right now, it's the most difficult point, I think, to judge these data.
What's more instructive for you at this difficult moment where we do get conflicting signals? Corporate earnings reports and some of the earnings calls, or some of this economic data coming out of the U.S. government?
Yeah, it's a great question. And I found in the past that the two usually line up well over time, in the sense that if you look at what you're getting overall from corporate earnings and then what you're seeing in the macro data, they tend to tell a pretty similar picture. Now, you've had a bit more divergence, I think, now, where a lot of the consumer-based companies are pointing to more concerns about the consumer than we're actually seeing in the macro data. But the macro data are much broader than any given company. So to me, I look at the overall spending numbers, and those seem to be holding up pretty well. So I take that as the biggest signal.
So in other words, more of the idiosyncratic makes sense to you when we hear certain commentary like what we were talking about with Dollar General versus systemic, or sort of the tea leaves. Is that correct?
Yeah, absolutely. I mean, there's no doubt also it's valuable to look at some of those corporate earning reports. I mean, for example, we've heard for a while that there are strains in lower income consumers in the U.S., and you see that in a lot of the macro data. We don't have that much great macro data to tell you what's happening there. So there you have to rely more, I think, on what the companies are saying. Those strains have not worsened dramatically over the last few years, but they're definitely there. So I think it gives you a better picture of the idiosyncratic. But for the overall macro picture, I think the economic data is the best.
I think we all remember a piece that came out in July from Bill Dudley, the former New York Fed president. He changed his mind. And in that piece, he talked about the self-reinforcing mechanism of seeing higher unemployment. It all starts to feed on itself. We saw in the confidence numbers this week that people are less confident about finding work. Yeah. Any sign of that starting to emerge, that self-reinforcing process of people starting to worry, pulling back on spending because of that? Are we in that moment? Why wouldn't we be in that moment based on that?
It's a great point. And, we've written in the past about this sort of stall speed framework where when growth slows a lot, it just tends to keep going in most cases. And one argument you can make for that is it's self-reinforcing, that consumers and businesses see the economy slowing and they pull back even more. Right now, you're seeing some moderation in those numbers, as you mentioned. Consumers are finding it harder to find jobs, relative to earlier in the pandemic. But I think a lot of those indicators are still at relatively healthy levels historically. And, so far, we're still not seeing it really in the spending figures that you're seeing the consumer roll over.
But should we be more interested in levels or change?
We should be interested in change. And right now, if you look at some of those consumer spending figures, they're moderating. You're seeing services consumption moderate. Maybe you're seeing some goods consumption pick up relative to that flat trend you saw for the last few years. So you definitely should be focused on the change. But right now, as I said, most of these data tell me the consumer is not rolling over and the labor market looks mostly to be moderating. Now, again, that could change pretty quickly, especially with these self-reinforcing dynamics. So I'm very interested to see where that next employment report comes. Even, for example, if the unemployment rate moves up again, even if it's for good, quote-unquote, better reasons that labor supply is increasing, I think the sticker shock of a 4.5% unemployment rate, something like that could really influence consumer expectations.
We've been talking a lot about the weakness in the consumer, and you've been telling us why you don't see it actually accelerating in a significant way. At what point do we have to start worrying about inflation again then? Or not worrying about it, but considering the fact that it might not go down to 2% and stay there if you do have an economy that's doing just fine?
Yeah, and I think with what we're seeing in the U.S., and we're also seeing this globally, I think the upside risks to inflation have greatly diminished. If you look at by component, food and energy inflation are running at or below pre-COVID levels. Goods inflation's running at or below pre-COVID levels. It's really about that services inflation, which is tied to that tight labor market. But as we've been talking about, a lot of those labor market factors have been loosening. And so I think you can have more confidence that that services inflation is going to continue to grind lower. You know, if the labor market were to somehow retighten and you see that unemployment rate fall significantly, wage growth accelerate, then I would start to get more worried that you could get a pickup in services inflation. But the way the dynamics are now, I think that upside risk has really significantly diminished.
Let's finish on Friday. We'd love your views on what to expect this time next week. When we sit here in a week's time, looking back about 8 or 9 minutes, and we've just had payrolls. The estimate is 163. The unemployment rate we're looking for is 4.2%. What do you think we should be focused on next week?
Yeah, absolutely. And, you know, our U.S. team, they're looking for an even weaker report than that.
They're looking for 125.
125, so a fair amount softer. And that's the big risk. As I said, we're at that inflection point. You know, that could be right, that things are going to slow down much more significantly. If you get a number like that, I wouldn't say it's, you know, definitely a sign that we're entering a sharp slowdown, but it's a much more worrying number than where consensus is. I would be focused really on what's going on in the household report with that unemployment rate, because, again, I think, you know, we hit the Sahm rule in the last report. More of it's been due to rising labor supply in this cycle than prior cycles. But, you know, if you get a significant rise there, especially if it's due to weakening labor demand, I think that's going to be a pretty worrying signal.
Rob, thank you. It's good to see you. Appreciate it. Have a great long weekend. Rob Sockin there of Citi. If you are just joining us, the opening bell is about 50 minutes away. Equity futures still positive across the board here on the S&P up 0.4%, on the Nasdaq up by 0.75%. The Russell, the small caps up by 0.6%. Yields drifting a little bit higher at the front end of the curve on a 2-year, up by 2 basis points. The 2-year 3.92. Economic data out just about 9 or 10 minutes ago. Mike McKee, just to revisit that economic data, what stands out for you?
Well, the thing that stands out for me is not in the headline numbers, it's the savings rate falls to 2.9%. Now, we had in 2022 1 month in the twos, but you go back to 2008, 7, 6, we did have the savings rate very, very low, and that was when we were getting into the housing bubble. Not sure what it means, but it does raise the question of where are people going to get the money to keep spending at the rate that we saw today, the 0.5% increase in spending. And the surprise in there is that we had a lot of spending on goods, goods up 0.7%, where services were up just 0.5%. So it's been the other way around. So people are still buying stuff, but the question is, can they keep it up? Wages up 0.3%, same as the prior month.
I'm so glad that you picked that out. I think that's fascinating, especially as we heard from Andrew Hollenhorst earlier, that's really his takeaway. We see stronger consumer spending that's upholding GDP. How long can that continue as that savings rate goes down what he calls more normal levels? At what point does it become abnormal?
Well, I think we are sort of below abnormal. If you look at the averages over the years, you're going to be somewhere in the high 3s to 4%. So we're below that now, which raises the question of what are people doing? Are they starting to raise the amount they spend on credit? And we've seen some evidence of that. We haven't seen it get out of normal ranges, but it's back into normal ranges. And where do we go from here?
Let's have that conversation right now. Gennadiy Goldberg of TD joins us for more. Gennadiy, let's talk about it, and welcome to the programme.
Thanks for having me.
Payrolls Friday this time next week. What are you and the team looking for?
Looking for a little bit of strength. We've had quite a bit of, I would say, uncertainty in the last couple of prints. You've had some lower prints, certainly. We're looking for north of 200K. We're looking for a, not far north, I should say.
Still north of 200K.
North of 200K. And, you know, very importantly, a decline in the unemployment rate. You know, obviously lots of questions about the Sahm rule being triggered, lots of questions about the direction of travel. The direction of travel is still towards weakening. But we are looking for a bit of noise in this data as we're going through this transition from very strong economy to, you know, whatever word you want to put on it, but maybe not quite so strong.
So 4.2 for unemployment again?
Exactly.
Something a little north of 200K on payrolls?
Exactly.
Where does that leave rates?
I think that leaves rates a little bit higher in the short term. I mean, you know, you've seen rates really rally quite dramatically over the course of the last month or so. And I think we've gotten a little bit ahead of ourselves. I think the markets are looking for definitely more than 25 basis points per meeting for the rest of the year. Some of that's going to start to get priced out as we get closer. And I think rates are going to nudge a little bit higher, maybe north of 4% on the 10-year. I think it's going to be a good buying opportunity for a lot of investors who've been kind of late to the game and actually getting long.
Well, how do we understand whether it's people who are late to the game who can plow in versus a head fake in the economy, that essentially everyone thought that we were getting some sort of weakening that we weren't getting, that was turbocharged by the Powell pivot that everybody saw at Jackson Hole?
I mean, that's the difficulty, right? We saw this back in at the end of 2023, where the Fed pivoted quite sharply. I think this is why they've been so cautious not to kind of overdo it. You know, the discussion of 25 versus 50. Why jump into this massive round of easing, scare the market, where, you know, it's really the direction of travel that matters to the Fed, I think. What you're seeing is mission accomplished on inflation, or something very close to there. And now you're worried about the unemployment rate. And if that continues to drift higher, you know, from a risk management standpoint, you have to start pushing rates a little bit lower, gradually, but you're over tight. So the direction of travel, I think, is what matters to the Fed, not necessarily every single data point.
So, not to extrapolate too much, but, you know, it's a Friday on a slow week when everyone's trying to understand things that are not understandable from any long-term trajectory. Pairing together what you're talking about with what Mike was saying, which is that the savings rate is heading to the lowest level, or has just reached the lowest level since 2022. And yet we're looking at a Fed that's going to be cutting rates. The U.S. consumer is not that leveraged. What is the fear here that we could be turbocharging a next cycle that will end in tears if you have already an okay economy and you're going to have a very low savings rate and you're going to have the ability to take on credit more easily with lower rates? That's been a bad recipe in the past.
Exactly. So, and I think that's what's keeping the Fed very cautious right now, that they're not keen to actually cut in 50 basis point increments. There really is no emergency as we can see it right now. But again, from a risk management standpoint, the direction of travel is towards a weakening economy, gradually, not significantly. And you're seeing this in the consumer. We all talk about the consumer. There isn't one consumer, right? There's all sorts of pockets. I mean, you saw the earnings from, you know, the likes of Dollar General. You're seeing lower income consumers certainly under a lot of pressure. Higher income consumers are doing okay. On average, and that's what the numbers give us. On average, the consumer is doing fine, but there are pockets of weakness here. And I think the Fed has to be attentive to that, because they do tend to precede bigger, longer-term kind of weakening in the U.S. economy. And I think that's why the direction of travel for rates is also to the downside as well.
Let's work with this. Let's go with your numbers for next week and push it through this bond market. Let's bring up the board. The 2 years at about 390, 10-year 388, 30-year, let's call it 415, 416. If we get your 4.2% on unemployment next week, something a little north of 200K, where's that bond market 5 minutes later? And I know this is crystal ball type stuff. I just want to gauge from you the kind of reaction, the magnitude of the move that you'd be looking for this time next week.
I could see rates moving about 10 to 15 basis points higher on that kind of reaction. Not necessarily on that day, but in the wake of that report.
But that's just the potential upside. Then you think it gets bought?
I do think it gets bought. You know, from my conversations with a lot of investors over the last few months, a lot of them have been very cautious, you know, to the earlier point, to jump into these markets with both feet. They've gotten burned, you know, back in December of 2023. They've gotten burned all along the way for the last couple of years. They're very cautious. They want to see the whites of the eyes of, you know, the downturn to really start getting long. A lot of them have been more cautious than they would otherwise be, even though they will acknowledge that the economy looks like it's starting to soften up a little bit.
So do you think we're just going to be range bound with just sort of these fluctuations back and forth for the remainder of the year?
I think range bound, but on a downward trajectory. I think that's the best way, you know, kind of a downward channel, if you will, in rates. The issue is maybe we've overextended a little bit in terms of the downward channel. I mean, we're looking for 10-year rates to finish the year at 3.4%. That might sound quite a bit lower, but it's really not. You know, a couple of week data prints and we're basically there.
What's interesting to me is a point that Eric Freedman of U.S. Bank made earlier in the hour, where he was saying people think there's a $6 trillion in money market funds and it's going to go flooding into longer duration. He isn't seeing that happening. He doesn't expect it to happen until there is some sort of material sell-off in the long end that leads to higher rates. Do you agree? Do you think that the money that goes into rates is going to come from elsewhere and we're going to see that money stay in money markets, in cash?
Yeah, I think that's one of the biggest misnomers of money market funds. If you talk to the money market funds themselves, they will acknowledge that that trade almost never happens. There are very few people who take money out of money market funds and invest it into equities or very long duration fixed income. You know, a long duration trade for a money market fund investor is maybe going out to 90 days instead of 30 days, right? That's your extension. I think a lot of that money is going to come from elsewhere. It's going to come maybe from equities, for example, or it's going to come from abroad with foreign investors actually starting to put money to work. I don't think that money is going to flood out of the money market space. In fact, I think money market funds are going to continue to see inflows albeit at a kind of a more modest pace over the next couple of years.
Because of the risk aversion associated with an economic downturn? Where does that money come from?
Mostly because I think, for the last decade or so, we haven't seen massive inflows into money funds because rates were rock bottom. Even if the Fed goes back to, let's say, a 3% neutral rate, if there is a soft landing, that's still 3%. It's still a very attractive rate from a long-term perspective. A lot of investors will be okay taking that. Obviously not as great as north of 5% as we're seeing now, but most investors will be okay buying into that.
This was deeply thoughtful stuff and at times slightly contrarian, and we appreciate that. Thank you, sir.
Yeah.
Gennadiy Goldberg there of TD. Lisa, lots to chew on.
Especially because this really kind of coheres with the data that we saw yesterday. Money market funds actually had their biggest monthly inflows this year. It capped $127 billion of cash into those funds in the month of August at a time where people were saying, watch that money flood out of there into everything else. It's not really happening.
It's not happening, at least not in the way people expected. We are 41 minutes away from the opening bell. Equity futures are just about positive, a third of 1%. Let's give you an update on stories elsewhere. Here's your Bloomberg brief. The latest US economic data showing the Fed's preferred inflation gauge rising at a mild pace and household spending remaining solid, suggesting policymakers are taming price pressures without causing too much pain to consumers. Nvidia is said to be discussing joining a funding round for OpenAI that could value the AI startup at over $100 billion US. As sources say Apple and Microsoft have also been involved in talks about participating. And finally, talk about a paycheck. Golden State Warriors star Steph Curry has agreed to a huge one-year extension to his contract that will pay him more than $62 million. It means the two-time MVP will become the fourth NBA player to pass $500 million in career earnings.
Can you imagine what they'd pay him to do a podcast on Amazon?
That's true. That's such a good take.
I mean, honestly, I think that this...
He should date someone in Oasis.
I can't even. Yeah, that's...
Won't go there. All right,
let's move on.
Okay, up next, your trading diary. Pull it together. Stocks are positive, a third of 1%. The opening bell 37 minutes away. As we count you down to the opening bell, here's the trading diary, the calendar for the week ahead. Monday, US markets close for Labor Day. Tuesday, we'll get S&P Global US Manufacturing PMI plus ISM data. Wednesday, JOLTS durable goods plus the Fed's beige book. Thursday, ADP private payrolls plus another round of jobless claims. And on Friday, it's the main event. It's Payrolls Friday. Enough economic data for you.
Yeah, next week's going to be the beginning of a stretch for 2 months that's going to be very different than the past week. It's going to be chock full of all sorts of data as well as, of course, political events. To me, I want to understand where the balance of risks is for this market. Is it, to Gennadiy's point, the idea of a potential sell-off of the bond market or retracement of some of the Fed expectations that we've seen built in post-Jackson Hole? Or is it on the flip side with weaker economic data? Frankly, it feels evenly balanced.
Finely balanced.
Finely balanced. Thank you. I can't even pretend to do Fed speak.
Mike McKee. Let's get a final word from Mike.
Like,
Let's
move on.
She sounds like Jay Powell, though. So
oh, yeah, big time.
I mean, I'm excited for next week because a week ago I was at the center of the universe with Jay Powell, and all this week all I hear is NVIDIA.
True,
Nobody cared about the economy.
We're doing a payrolls party.
Now
you
we
feel
get
left
payrolls.
out and forgotten.
Left out and forgotten. But next week we'll be busy, and it'll all be about the payroll indicators, the labor market indicators, jobless claims, JOLTS, your favorite ADP, and then, of course, non-farm payrolls, because the Fed has said basically we're looking at the labor market to make our decision on the 18th of what we do from here. And we've got pretty good news today on the inflation side. So unless something happens, it's probably not going to be a big CPI before they meet. So it'll depend on the labor market. We'll get a lot of clues this coming week.
This week we're looking ahead to last month, or in the last month, was pretty unsettling for a lot of people. Manufacturing ISM, the employment component of that, jobless claims, the payrolls report. Have we put all of that to bed? Is there anything outstanding for you that's still just a little bit unnerving?
Well, I think the surprise might be in the manufacturing side. We saw in the numbers today that manufacturing wages went down, which suggests some real weakness there. We'll see that in the ISM numbers coming up. So we'll see that. And then Friday, the manufacturing hiring. And those are higher paid wage jobs. So that could be an issue.
Just quickly, ADP actually has gotten some attention recently as having been more telling than other indicators in the past, even when it comes to just revisions. What do you make of that?
Probably coincidence, but I mean, they're all friends of mine over there at ADP, and I respect their work. But it's not supposed to be an indicator of what the payroll numbers are going to be. So if it's close, that's good. If it's not, I mean, do you want to bet your salary on them being close again?
Are we putting more weight on ADP? Is that what you're saying?
I don't know. I saw some examples of how it's been more accurate than some of the previous. Yeah. So, I mean, I was just wondering if there's any credence to that. And Michael said, no.
Mike McKee, thank you, sir. Coming up on Tuesday, Marvin Lowe of State Street, Matt Orton of Raymond James, Anna Rosenberg of Amundi, and Brent Shuley of Northwestern Mutual. For all of you out there from New York City, thank you very much for choosing Bloomberg TV. Have a brilliant long weekend. This was Bloomberg Surveillance.